Good morning, ladies and gentlemen, friends. Welcome for this second day of the 46th Interarab Cambist Association. I'm so happy that you didn't take as much mint tea as I expected yesterday, that all of you are awake and ready for this opening session this morning. So I'm very, very pleased to introduce on stage to give you her remarks and her view of the global economy and, of course, of the Moroccan way and the trajectory that Morocco is taking. Ladies and gentlemen, please welcome the first woman Minister of Finance and Economy of Morocco, known as the lady who doesn't crack under pressure, your own Nadia Ftah. Thank you very much, Madam Minister.
Mr. President, ladies and gentlemen, distinguished delegates, it's a great honor for me to welcome all of you to the beautiful city of Marrakech for the 46th Interarab Cambist Association Conference. We meet today not just as representatives of different nations, but as architects of the future, experts, economists and thinkers debating pressing challenges for exchange, markets and forex trading, and we are committed to build a stronger, tech-driven, sustainable economy. In this rapidly evolving and interconnected world, in a polycrisis context, holding high-level economic forums in Morocco highlights its growing influence and strategic position in the global, continental, and regional economic areas. Annual meetings of the World Bank and the IMF that took place on October 19-23, Africa Investment Forum from on November 8 to 10, 23, and the selection of Morocco for the third time to host the annual conference at the Inter-Arab Cambist Association, to name only the most recent meetings. These events were an occasion to debate on global finance stability and cooperation in order to drive economic growth and nurturing investment opportunities across the African continent. Bringing together the global economic and financial quota in Morocco is also a unique opportunity to recall undertaken reforms by the country, adopted programs and strategy, transparency of economic policies, improvement of the business climate, exchange rate regime reform, more flexibility of the exchange rate. In addition, we should mention political stability, social and financial inclusion, gender-specific approach, efficiency, and effectiveness of governance and fighting money laundering and counter-terrorism financing. Finally, we are not allowed to omit the firm commitment of Morocco to develop our continent by fostering South-South cooperation. Today, as we convene at the 46th ICA conference, our attention shifts to regional collaboration within the Arab world, addressing unique market challenges and opportunities. This gathering holds special significance as it not only highlights Morocco's role as a vital link between various economic regions, but also reaffirms our commitment to fostering strong economic partnerships. The participation of Morocco to these various forums is a demonstration of its active commitment and strategic vision in harmonizing different economies' discourses. It is a reflection of Morocco's dedication to shaping a cohesive and prosperous future, not only for ourselves, but for our global and regional partners, under the leadership of His Majesty the King Mohammed VI, may God assist him. His Majesty has insisted on several occasions on the digitization of the administration, on social cohesion, on green finance, etc. As we navigate this complex tapestry of economic landscapes, Morocco stands poised to lead and innovate, embracing its role of the heart of these multifaceted economic dialogues. Combining tradition and modernity, Morocco's journey has been marked by a rich history and a dynamic present, where the old and the new come together to create a unique mosaic of progress. Our strategic location as a gateway to Europe and for Africa, our diversified economy and our commitment to renewable energy exemplify our strengths. Yet, these strengths do not shield us from the challenges of market volatility, the pressing need for technological progress, and the urgent call for sustainable development. Overcoming these challenges is not a task for a single nation alone. It requires a shared vision and a collective effort. This conference takes place in a context of uncertainty characterized by significant transformations of the global financial markets, due in particular to high interest rates, geopolitical challenges, and polycrisis. Discussions might provide critical insights on how to deal with these constraints. This meeting is also an occasion to address issues relating to energy transition and decarbonization, particularly in a regional level, and financial institutions will play a prominent role in this field. Our commitment to sustainable development is embodied in projects like Noor Ouarzazate, the world's largest concentrated solar power plant. These initiatives are milestones in our journey towards a greener economy, but they are just the beginning. In this context, thanks to his commitment to energy transition and decarbonization, alongside the annual meetings of this year, a significant green financing has been granted to Morocco with the aim of promoting a sustainable economy. Aware of the transformative force of our digital technologies, in particular its impact on financial markets, and that the future economy is undoubtedly tech-driven, Morocco is nurturing its digital landscape to encourage technological entrepreneurship and innovation. By investing in digital infrastructure and supporting tech startups, we aim to position ourselves as a hub for technological advancement in the region. E-commerce increasingly occupies an important place in the national monetary landscape. According to Interbank Electronic Banking Center, the CME, Moroccan card payment transactions totaled 120 million operations in the first 9 months of this year for an amount of almost 40 billion dirhams, up by 20% in number of operations compared with 22, and by 16% in a total amount compared to the same period. These figures demonstrate clearly the dynamic of e-commerce, but also point out the role of the GAFAM in this dynamic and their importance in the international economic and financial landscape, a challenge that our countries must overcome in terms of supervision, guidance, and regulation. Morocco is also aware of the impressive growth of cryptocurrencies and crypto assets. They are challenging traditional financial system studies, and consultation are conducted to assess their impact on financial markets, opportunities also they offer, and challenges they pose to the regulators. Furthermore, Morocco makes efforts to foster the integration by investors of ECGs as a criteria when making investment decisions while achieving financial returns. As we look forward to the future, our vision is clear: to build an economy that is resilient, innovative, and sustainable, an economy that that not only thrives in the present, but secures also prosperity for future generations. This vision, however, can only be realized through collaboration, through learning from each other, and through shared innovation. In closing, I extend my heartfelt thanks to all of you for being part of this important conversation. Let us make the most of our time together in Marrakech, not just in seeking solutions, but in forging lasting partnerships that transcend borders. I thank you.
Thank you, Madam Minister. If we can hold you just for 10 seconds to have Tamer Khalifa and Reda Mekibarada for the family photo before you can leave. And thank you so much for being with us, Mr. Chairman. And then please don't leave the room because I have very important announcements to make right after this. Thank you very much. Thank you, Mr. President. Thank you, Madam Minister. Thank you so much. Okay, ladies and gentlemen, as you know, I have bad news and good news. I shall start with the bad news. We closed the doors so you cannot get out of this room, and we removed coffee from the hallway. But the good news is that we have an amazing panel which is about to start about digitalization as a turning point for markets. So without further ado, let me introduce your moderator who's about to get in, Hassan Basadi. Hi, Hassan. And give him a round of applause and his amazing speakers and panelists. I turn the floor to you and the baton of moderation to you.
Good afternoon, everybody. Oh, good morning. Thank you so much for joining us today. I'm going to be introducing our esteemed panelists. Hopefully, I can remember the order that they're in. So first coming up is Mr. Babakar, founder and CEO of Petale. Welcome. Have a seat. Next, we have Candice Bisek, followed by Tia, Michael, and Nadia from OCP. Fantastic. I'm very pleased to be with all of you guys, and hopefully we can have some nice discussions with regards to technology in tech, technology in finance. And to kick it off, I guess my first question will be to Babakar with regards to your understanding of tokenization and digital assets, the application of these technologies in the financial space, how banks should be looking at this, and you know, from your experience, we'd love to hear a little bit about that.
Thank you very much. Thanks for the opportunity of sharing the experience of my company. My company is called Petale Group. It's a financial fintech based in France, Paris, and operating globally. We had been building since 3 years capabilities for allowing the tokenization market to be developed on a very good way, respecting the regulatory framework in Europe, and we had been also looking at the market outlook of the tokenization, and we had been very surprised to see the positioning of one of the major players in the market, BlackRock, the CEO of BlackRock, that considered this market as being a challenger of the crypto asset market, because from their understanding, it will be the first time that the financial industry, the traditional financial industry, will gonna appropriate that blockchain technology with a concrete realization. So he considered that the tokenization will gonna take approximately 10% of the GDP in terms of volume of transaction for the financial market, and that's why a lot of bankers, asset managers, and company fintech like my company are looking at that market. So tokenization is from our company. It's just something that existed before. That's we call titrisation in French, but in English we call it securization. It's making a financial contract on a negotiation and then put it on chain, on a blockchain. That's what we call tokenization. That is a quick introduction of the question. Maybe you're going to go deeper after.
I mean, I guess my next question is for you, Thea. I mean, we talk about digitalization, we talk about digitization. Fundamentally, what are the differences, or are they technically the same thing?
They're similar, but I would say one builds to the next. So one is transforming data in a digital way, so think putting KYC data on the blockchain, for example. And the other is creating processes with digital ways. So think about, or quick raise of hands, who here has used ChatGPT? Most of us, right? Yeah. So building automation and digital processes is the next. So they're very related, of course, but I say one is the foundation to the next. And of course, we're seeing digital transformation and digitization across every industry. So it's very relevant. That touches all of us in many different ways.
Fantastic. And with regards to so digitalization comes first, then digitalization, and I guess the next step is digital transformation.
Yes.
Fantastic. Looking at digital assets, how do we, with regards to the digital assets, there's at this point still a bit of a taboo on the subject. I mean, do we see at any point financial institutions actually embracing digital assets as a instrument that they provide to their customers? And I mean, Michael, I guess maybe you'd like to hear that from your perspective.
Yeah, absolutely. So, I mean, digitization has changed a lot. I often get asked the question of, are banks dead? Banks are not dead. Banks are not going anywhere. And at the same time, there has been a transformative change in what is possible and the financial inclusion we are seeing, which is mobile money. And the fact that the telcos have now realized that they have a distribution network that allows you to plug in folks that had no access to banking services, no access to digital finance via their phone. Now, telcos will not replace banks because telcos rely on banks for core banking services, for FX, and so on. And we work now in about 40 countries. And in the places where the banks have fought the telcos, I think it has turned out worse for everyone. And where they have partnered and realized, look, this is an opportunity. The telcos offer a distribution network that we don't have as a bank. We don't have a bank branch in every rural location. That's where we've seen the most success, not only for the consumer, but also for the banks and the telcos.
Fantastic. Maybe a question for you, Nadia. What is the key blocker, in your opinion, to that digital transformation? Is it regulation, technology? I mean, what do you think is the fundamental main reason or blocker to that journey of digital transformation?
Well, when you think about what stops digital transformation, first of all, you think about regulation. Since financial services are very heavily regulated, and so you think that regulation is a blocker, and you have two types of regulations. You have national regulations, you have supranational regulations, And also you have specific regulation to the financial services, and you have more general digital regulation. So as for data, for example, GDPR, then that can be also extraterritorial. But sometimes regulation can be an accelerator of digital transformation. And I will give a simple example in the global trade. You have an initiative from the International Chamber of Commerce to drive digitization and paperless global trade through model law on transferable, electronic transferable records, which on the contrary insists and helps all the players to develop this digitalization. And this is particularly interesting for enterprise. So it's not, digitalization is not only a question for consumer, but it is also more and more the very important question for the enterprise customers of financial services. And so last, I will really answer your question, because as regulation can be plus or pros and cons, in reality, the real blocker or engine of digital transformation is the fact that is a vision and a real project for the executive leadership team. So you have to have the vision and the engagement of the top management in companies really to make it possible, because as Claire said, it's not only digitization, it is changing your operating model, changing and sometimes disrupting your business model. And maybe I will just stop there to say, of course, you have digitization, you have digitalization, you have the digital transformation, and now, thanks to generative AI, thanks to what is democratized this now as ChatGPT, for example, now we are entering a post-digital era.
Interesting. And just to expand on that, looking at regulation, I mean, what's the role of government in all of this? Because, I mean, in a lot of instances, government can be a supporter, could be potentially a blocker. What's the role of government in either ensuring some level of control on it or letting it run free? I mean, from your perspective, how does government play a role in pushing these services to customers?
Well, as I said, the government is key. I would say it's the most executive leadership at a nationwide and not only at the level of a company. So, of course, the vision and the action of government is key. And also because governmental organizations are the ones that have a possibility to enter into multinational negotiations. So, of course, it is key.
Thank you so much. Go ahead.
I'll just hop in on the government. So a lot's been made of digital assets and the role of government. Like banks, governments are not going anywhere. Governments will continue to issue currency and control currency and capital flows. One thing that I would encourage that we've been seeing is it is a difficult macro time. Many currencies are devaluing, and you will often see governments intervene and try to fix an exchange rate during this kind of devaluation process. And we can look at what's happening in Egypt now. There are many countries at which this is happening. The result of that is often a shifting of remittances that are formal and that are controlled by the government and visible to the government, to the informal sector, hundi, hawala, whatever, which is invisible to the government and will not be strengthening your foreign reserves. So as you think about the implication of those actions, I would just think the freer, the minister mentioned this, the flexible exchange rates, as a currency devalues, you tend to see more remittance come in, which is buying the local currency, strengthening the local currency, and helping to stabilize that devaluation. So just kind of, as I'm seeing this around the world, the importance of a flexible exchange rate, especially in these times, has never been more important.
Thank you so much for that. I mean, I work for Integral, and definitely COVID was a major accelerator for technology adoption, digital transformation. From your perspective, Candice, I mean, what have you seen? I mean, what was the impact of COVID in terms of timeframes of these projects?
COVID was, from the technology perspective, a blessing in disguise, even if it had dramatic consequences, in the sense that he has totally shifted the standard and the importance of digital readiness in business. He has transformed the way we interact with each other, in the sense that remote work became a real event even for organizations who never had that culture. But also it highlighted the importance of e-commerce and digital payments. Businesses, hospitals, schools had to find a way to deliver value digitally, but also to receive payment digitally. And it became essential as a tool for business continuity, survival, and resilience. So as much as it was a crisis and a disruption, it was also a factor to accelerate the digital literacy, the upscaling, and the awareness of leadership, whether it's in business and government, of getting an environment that is digitally ready.
Fantastic. And a question maybe going on to that, Tia, from your perspective with your experience, and I mean, Candice, I'd love for you to jump in on this too. How have you seen the customer, how do you feel the changes in customer behavior with regards to how they want to be served? From conventional, going to a branch vis-a-vis using applications, on your mobile or on a website and stuff. I mean, what have you seen in terms of trends? How do customers in this day and age want to be served?
So I think what's interesting, and adding to your point, sort of need is the mother of invention, in the sense that during COVID we were all forced, indirectly or directly, to use these technology infrastructures that exist and sort of scale that experience. But what we are noticing, especially at GetB and all the things that I've seen and built, is that yes, we have all this automation and digital transformation, which is great, but what is the actual problem that you're solving? And I think in this world of technology, we think about the world of tech quite a lot, and we talk about technology, but at the end of the day, every click is a person. There's a person behind every screen. So truly understanding the foundational need and the person behind the screen still becomes very important. So to your point on how to serve customers and the needs that we have behind the screens, what we've seen in this world of automation is that personal connection, that human connection, and understanding the basics of how you do business offline, and then how to translate that into a digital experience that's still personal and relatable is very important. So I think that's an interesting question, or a takeaway for everyone in the audience to remember as well, is at the end of the day, how can we translate that into a digital experience, but truly understanding the person behind the screen.
And to build on understanding the person behind the screen, the people behind the screen are increasingly young and demanding, and have more and more options. Talking about people, you have to use your phone to get your food delivered at home. You use your phone to find your next wife or husband. You have the world at the fingertip of your hand. So on the other hand, this will translate in people not necessarily wanting to go to their branch. We were having a conversation about that. To go to their branch to have a proper service delivered. They want to feel the ease while using mobile bank's app. They want to feel, basically, to have the option and that comfort, including with their relationship with their financial institution. So it's not necessarily a matter of, do we want to transform digitally? Do we want to be digitally ready? It's going to be a matter of survival. And because customers these days are less and less loyal by nature, it's going to be the survival or the most digitized, basically, the survival of those institutions who have learned from the most advanced tech companies or the best example of digital transformation of businesses and apply it to them. Of course, companies will not be able to fully transform if there is not a support from regulation. But I think it's very important not to consider it as disruptive or complicated, but rather embrace it to make sure that there is this alignment with the next generation of investor, user, that will be like younger, more digitally exposed and more demanding.
Thank you. Just Nadia, I guess to jump to you now, from basically working at the largest corporate in Morocco, and a lot of the bankers that serve OCP are here. From a corporate perspective, how do you expect from a digital experience, or where do you want to get to with regards to how your banks are able to facilitate business with OCP, as an example, from a digital perspective? What are the expectations on the corporate side of things?
Well, it is really important, and the example of the global trade is very important for a corporate company which is industrial, which trades on physical goods. For example, we had the opportunities to experiment blockchain technology for our trade, so that, and we were accompanied with also our banks on this. So it is really a partnership with all the players trying to really two things. First of all the costs of transactions, so help us optimize the cost of transactions, and on the other way, we also have to have a better experience with our customers, and so all that is related to payments and all that is related to financial services, we also have to give our customers a global experience, seamless experience, multi-channel experience. Yes. So we have to have an experience that is very close on digital marketplaces, on physical branches, etc. So we are, as global corporates, confronting the same challenges than our partners in banks or financial services in general, or fintechs. So we are serving global consumers on the different countries, and these consumers now expect to have everything they want, everywhere, real time, and free. So the question of transaction costs is very important, and the experiences of having services that apparently are free is very important. And also, I have to insist on the Gen AI revolution. I think that everybody thinks it's a hype, but it is going to be mainstream. And this revolution has the opportunity to completely disrupt the costs of operation. The impact on productivity will be huge, and we already see that in certain businesses. For example, the IT development. I know that financial services consume a lot of IT development. The IT development with AI will have zero cost. The opportunity to have the information. So in the digitalized world, to access information was still difficult because you had to build proper data sets, and you had to have a proper data governance. Okay, all these costs are really driven close to zero with Gen AI. So I think this is something that is emerging now, and that all the players in financial systems have to adapt very rapidly.
Please.
We can build on that. We, as a fintech company, we have seen that the retail customers, the way that think about bank is they on their mindset, they think about an application on their mobile. They don't really figure out that the bank is an institution that protects their deposit, that offer them financial product. They just they tend to go on thinking that the bank have to act like Amazon or just getting a quick delivery of their service they want. And behind that, you have a lot of new adoption customers that comes, and that this movement, bring the retail customer to go directly on the blockchain and investing on crypto money, digital asset, and they think that they can generate a lot of revenue just by selecting one cryptocurrency, and they, without no financial education, they go into that. And the result of that is you have a lot of retail customers that just use the bank as minimum services and payment services, and they also try to build their revenue and on top of the application they put on it. And the other things we have also in conjunction of what you say is the partner are obliged for a bank perspective. We have seen the multiplication of what we call API development. An API is an interface that you offer to an external party that can connect to your system, and then you interact, you exchange services. And this was a good shift since 10 years, because now with the open banking, the open finance, more and more partners work with banks to deliver services, even additional services. And this trend is obliging, I think, the institution to rethink about how they deliver the integration of their service with external services. So it's an opportunity for a company like mine that build services on top of financing, but it's also a challenge of fitting with regulatory framework.
Please go ahead.
Babak, I just wanted to hop in on the API point because I think it's an important one. I know there are a lot of bankers here. So I started with banks are not going anywhere. Banks will stay at the center of the financial system, in my view. Now, there are three paths I've seen banks take. One is the old path. The bank is closed off. Everything lives within the bank. So if you want a savings account, if you want to borrow, you come to the bank. You come to the physical branch. It's kind of the old world. The next generation was banks realizing that that core infrastructure, the regulatory aspect of the bank, could be used by others. And they were what I'm calling manual partnerships. So the bank may lend to a telco, the bank may lend to a fintech like we are, and you have those interfaces, but they're the old human-to-human interface. They tend to be expensive, they tend to be slow, they tend to be cumbersome. What we are now starting to see are banks that are digitizing and becoming part of that digital ecosystem. So creating the API for borrowing, creating the API for saving. And what that means is someone like us, Tap Tap Send, could plug into that. So we help people send from, let's say, UAE to Morocco. If a bank had an API, we could let our customers save from the UAE, from the US. So now you have another source of capital inflow, another way to help stabilize and strengthen the local currency. And as the bank, you've now made it easy for any fintech, any other company to get assets into your bank through digital APIs. So I think that's the way I would be thinking if I was running a bank, of how do I make this as easy as possible for this evolving ecosystem to plug into me seamlessly, quickly, and cheaply.
Excellent. Thank you so much for that. And maybe, Babak, a question for you. Obviously, conventional currencies and digital currencies, I'm sure there's, I mean, till today, we're looking at T+2 settlement for normal FX transactions. What can conventional currencies learn from digital currencies from that perspective?
Yeah, actually, if I summarize one word, it is velocity. You know, it's in the past, money was circulating. Central bankers were printing money based on financial forecasting, and then there was distributing the money, and bank was having the role of securing the money papers, and the distribution was done on the real economy. And today what happened is we have companies that create cryptocurrency without no ultimate target, and they just use it as a gambling function, and there is sometimes no utility except on doing trading without no control role. So there is the digital currency is a new form of money because it's the value that is just transferred into encrypted functionality. It does not mean that there is no value on that cryptocurrency because it has been digitized and put into a cryptocurrency wallet. And the thing is there is no lot of application that happen today except it on trading, on different exchange. And the way we see that is one of the biggest success is on a company in the US that have issued cryptocurrency, very famous, that is transacting on different network, and they are acting as money. They even say that it's a digital US dollar money, you know. So that means there is not a big frontiers between traditional money or just money and those cryptographic money that we call digital money. So I think what we have to learn from that recent experience of the blockchain industry is there is a way of optimizing the way that we create money, because we can have a lot of information that comes from the market on a digital way. And we have some new capabilities with artificial intelligence to put some mathematical function, some predictive analytics, and a lot of things, use case that we use on IT to calculate the way we calculate inflation, for instance, the way we have to calculate that velocity, how a company or a country want to manage that liquidity. And so, and then you have a complexity that's come there because we cannot call a cryptocurrency, we cannot give it a name of money because the money is issued by the country, and there is a sovereignty aspect of that, and there is also mass control and a lot of things. So the learning from there, I think, is we can capture is if we have to let that market to develop on a good way, we have to have different things that happen, like when internet was coming at the earlier 2000, and we had some website where we can order without not being able to pay. Then we start seeing some standard that come to the market for the payment, for instance, some security process that come to that. And it's a great opportunity for encrypting value, the blockchain and the token. All those new things are really great opportunity for the financial industry. And the way that my company is using, I can mention one use case. We have developed multilateral trading platforms, which is under the approval of the European, of the French Market Authority, that issue a security token, which is a token that have the characteristic of a security that we offer to our investor as a tool for them to invest into our fund. And once they go to that first stage, we just use that liquidity to inject in the real economy using an investment strategy. Okay, this is a use case, a real use case that is good for our investors, for the country, for the economy. And you can have the same use case without no regulatory framework, and it gives you, unfortunately, to bad implementation. This is what we have seen the last 2 years with a lot of failures on the crypto industry. It's just, I think, a question of implementation. It's an opportunity for which we need. Europe did very well on the regulatory framework with MICA, and then this gives a very great opportunity for implementing those type of digital projects. And Emirates, United Emirates did the same framework, and we have seen a lot of projects like our company is just starting to build. So the learning from us is digital currency is not money, because money is protected by country, but the technology behind we call it digital money can be used for setting up a new investment framework, like my company is doing. Yeah.
Fantastic. Michael, as the founder of TapTapPay and focusing on remittances in the third world countries for the unbanked, how have you seen uptake of technology in the countries that you serve? And from your perspective, do you see digital banks specifically and remittance companies like yourselves? Do you see yourself as a partner to the banking sector or competition? I'd just like to get your thoughts on that.
Yeah, first one thing, so they're not emerging markets, these are the growth markets. These are not emerging markets, they are the growth markets.
Okay.
So we send from US, UK, Europe, UAE to 40 countries, but this is where growth is happening. If you look at Africa now, Nigeria, 50% of the population is under the age of 19. This is where growth is going to come from. So I always reject the emerging. They are emerging and they are growing. In terms of digital, I talked a lot. We absolutely partner with banks. Everything we do depends on banks, whether it's banks in Morocco, banks in the US, banks in UAE, everything rides on the bank rails. To come to the digital asset and crypto point, I would say the following. Right now, the global banking system is built on SWIFT. Nobody today would rebuild the SWIFT system the way it is built. Nobody thinks that T+1, T+2 settlement is the speed at which money should move around the world. I think everybody agrees on that. And at the same time, SWIFT is the network on which banks have been built, right? There is a reason venture capitalists invest in networks. They are very hard to disrupt. Because once you have the network in place, you need a massive coordinated effort to replace that network. Whatever you think of blockchain and crypto, I think it has opened a window where the world has sort of coordinated and said, we can do better. We don't need to wait 2 days for a wire to arrive. We don't need to have a wire room where people are manually checking that the wire has arrived. And you see countries doing that without crypto, whether it's the US going to the FedNow system, like UAE has instant settlement is happening. Some places maybe it's on something that looks like blockchain, but you don't need blockchain to move towards an instant settlement system. Assuming we get there, the next question is, what do we do with it? What can we do with instant settlement? What can we do with faster movement of money? In TapTapSend's case, we're offering essentially instant remittances. So if you go back 10, 20 years, you send money through Western Union, the norm was to wait. You wait a day, 2 days, 3 days for your money to arrive. You keep checking, or your family member keeps checking with you, and that was the expectation. We're now in a world where most of our transactions are completing in less than a minute. What that means is, we just had a case of this. Your mother has emergency surgery. She's at the hospital. It's a cash-based system. She needs money in the next 15 minutes. We can get that money there across borders, but that is possible because a lot of the innovation that's happening around us, whether it's mobile money, whether it's instant settlement, and so on.
Fantastic. Candice, I guess maybe talk a little bit about Africa. We've seen that Africa has always been, looking at the likes of M-Pesa and stuff, been kind of at the forefront of digitalization and mobile payments, etc. What do you think the reason is for that, and shed light on that?
I think that it's the as they say in English, when life gives you lemon, make a lemonade. I think that the development of mobile money in Africa is the perfect proof of that, because yes, you have the demographic with the very youth-driven population that is therefore more prone to adopt technology. You have the high mobile penetration rate, and you have that entrepreneurial spirit, flexibility, that is also a consequence of environment that are sometimes not that stable. But all those pluses are combined with challenges like poor infrastructure, still relatively high level of unbanked people, but also the developmental constraint that makes that people still rely a lot on family solidarity through remittances. So you have those weaknesses combined with the strength that made mobile money an obvious solution, like the solution that allows you to have access to some form of bankarization, at least unmaterial transaction. You have the fact that it helps with remittances. You have the fact that it's driven by mobile that is highly adopted in Africa, and I don't think it's going anywhere. And it's also a beautiful lesson of optimism. Like we can look at our quote unquote weaknesses and complain about them, or we can ask ourselves, how can I turn these challenges into a golden opportunity? And mobile money and its development in Africa is a wonderful example of that.
Fantastic. Maybe moving on to a little bit of AI, and I guess maybe we'll start with you, Babacar. And Nadia. I'm looking at AI, I think with the likes of ChatGPT, we're still kind of using it in a less sophisticated manner for help with support or being able to get large pieces of information synthesized for you. But when do you? I mean, at what point? What's the critical? At the point of inflection, whereby you see that AI will be actually powering decision making, and I'd love to hear from both of you on that.
Yeah, when it's come to artificial intelligence, our company, we think that it's a technology that have a lot of potential, and that's why we have partners. We have a partnership with Microsoft and OpenAI to look at those perspectives that can be applied for the financial industry. We do consider that there is a lot of room for optimization. We are just at the early of the technology capabilities. It's also a technology that have to be parameterized, controlled, because when it's come to finance, it's based on math. There is we cannot create a model that we need to have someone that have the liability. Okay, because we cannot say it's my investment robot that make a decision. I have nothing to do with that recommendation. So our company is developing a set of robots that help our investment fund to operate as a digital investment fund, and we use all the science to be able to build something that will be very strong in the coming months and years. And we start by looking at trying to not replace the investor managers, like the asset manager or the investor, and we just try to copy and paste their existing process. And we say, what happens when you make a decision to invest to an asset? As an asset manager, you start to evaluate the asset and then go into the market opportunity. You go to the pricing of that asset, the historical data, and you apply some probabilistic mathematical function, and then you get into a quant formula that lead your investment decision. So when it's come to that process, it's something that can be implemented very easily. This is what we are doing to get the maximum of automatization of those type of process. And then it's bring efficiency on the execution, and it's also decrease the error margin when you do calculation computation. But it's always something that have to come with the human decision, with with that also come to market analysis, market forecast, market outlook. It cannot just be at that stage today of artificial intelligence led as an autonomous function that make financial decision. This is the level of implementation from our company. And if we look at from a partnership point of view, we have seen that these technology have also some potential of creating matching, you know, because the financial market is so spread it out with different regulation from different country, with different liquidity volume that go from one country to another. You need, if you have a artificial intelligence implementation, then you just do what the financial market did 20 years ago when we interconnected the New York Stock Exchange with the London Stock Exchange with the French Stock Exchange. Then you get a real-time view on the liquidity and where to make a decision. So we think this is an area where the trading facilities we're going to improve if they have a group implementation. And yeah, our company is implementing this because we need, it's a tech company, so we have to do some R&D on that, and what we also do for working better with the bankers and the exchange platform. Yeah.
Nadia, would you like to add on that?
Yes, I think it is very important because we talk about AI, but when we talk about AI, there are two things. There is traditional AI, and there is Gen AI. And Gen AI is not revolutionary only because we have the natural language interface, which is very important because it drives democratization. But it's not only that. It's not only the natural language interface that enables everyone, even children, to work with the artificial intelligence. One very important feature of Gen AI is that the models are able to work on types of data that were not trained on. Because traditional AI, you have data sets, you train the model, so you have correlations on your parameters, and then you can enter the same kind of data to have outputs. It's quite like optimization models or statistical models. Gen AI is really something different because the model can work on new data, and the model also can scrap a lot of data. One feature of this, and it is very important in business, we don't know yet all the impacts, is that for the time being, to have some insights, so informational insights, you need to have your data sets properly done, and then you could have insights. And to have your proper data sets, you needed to explicit the data. So you could work on structured data at the beginning. You had databases on structural data. Then you could, with data lakes, use all the unstructured data, so it is much more data. But in a way or another, someone had to explicit the information and the data. And as you know, in companies, 20% of the knowledge is explicit data, but 80% of the knowledge is implicit data. What is Gen AI doing now is that it is giving you access to the implicit data. And for example, in the investment area, you have your analysts, you have your investment bankers, you have the best of them, and you have the others, okay? You don't really know why they are the best, why they are really outperforming. You have a lot of statistical models who try to do that. And myself, I began my career in quantitative research and quantitative models. But now, you have these AR robots that are just looking at the behaviors of the bankers, and giving tips to the others without expliciting why. That is a problem also of AI, because we don't have the possibility to explain the models. But the fact is, it is able to catch the tacit knowledge, and then you have an impact that is, it is closing the skills gap in organizations. And also, this is something that is emerging. We don't really know what are the impacts. For example, one of the impacts in consumer relations business is that we think, and people are just experimenting, we think that there will be a gain of productivity of more than 30% due to Gen AI and due to the captation of the implicit knowledge. So this is really a revolution, and it will impact the investment banking, for example. It will impact trading activities, and more people will have these robots capturing the behaviors of players and helping the majority of players to have the same skills or the same results than the best of class. So it is really going to change the game, I think.
Thank you for that. Thea, from your perspective, looking at the aspect of insights from customers, how does that affect your side? I mean, does AI play a role with regards to your side of your experience looking at applications in fashion, etc.? Does insights help present a more personalized experience for the customer?
Absolutely. And I think we also work very closely with Microsoft on that topic as well. And to your point on the insights that we're seeing, there's so much that you can learn from the data. But a takeaway for everyone in the audience as well, there's a lot of hype around AI. We should say that as well, right? There's a lot of talk on AI, generative AI, and so on. But with any technology or any tool, what is the desired outcome that you're looking for? What are you really prompting the AI or the outcomes for? And that's a foundational element in any business. So that's something to think about no matter what kind of AI or foundational tools you're using, is really understanding the insights or the problems that you're solving for to sort of prompt it in the right way and get those insights that you really need or want to see. So for example, in our use case, we're transcribing sales conversations, analyzing those sales conversations, and seeing, sort of tagging them and seeing what words come up the most, what questions do people have before they buy. These are otherwise insights you otherwise wouldn't see in a day-to-day conversation. There's so much you can learn from that data, not just for your sales team, but for your marketing team and other people as well. So it's truly understanding why you're trying to get those insights or why you're trying to use AI, and truly understands the outcomes that you want to get from AI in that perspective too. And not just saying that you're using AI for the sake of AI, because I think we're seeing a lot of that in startups and technology, right? There's this hyperinflation around the word AI or .ai, but I think it's important to use a responsible perspective on how you're using AI as well.
Very, very, very insightful. We're coming, I guess, to the end of the panel, and I'd maybe like everyone here to answer one question for the audience, which is, how does a bank plot, and we're in a room full of bankers mainly, how does a bank plot out their digital transformation journey? And maybe we can start with you, Babacar, but just a few words from everyone. Yeah. It would be insightful, I think, for me and for everyone in the room.
Yeah, I think the first word that comes on my mind is interoperability.
Sorry?
Interoperability, because we are working on the world that is really sophisticated in terms of technology and integration, and if you are not connected on the global economy on a digital way, you are just disconnected. You are out of the game. And this is the worst case that can happen to bank or even company like us, is not being connected. So that's why we have on our industry, which is the blockchain industry, everything that is not automized, we call it off-chain. Off-chain mean it's not on the chain. That means it's not trustable, you know. And blockchain is supposed to bring trust for any players. Every time you integrate a blockchain and you are very transparent on your operation, that can be auditable, by the way, then you participate on an open market that can be auditable. And that's why we believe on trading platforms that operate on a very transparent way and using technology, blockchain technology and the features. And the second things that come on my mind is just to look at the customer trend. Today, the customer are using the digital platforms because they don't have time. Whatever they do, they want to go very fast, very quick. And by giving them the possibility to do what we call self-servicing, so that means they don't need to come to your bank and do what they want. If you gave them self-services, they will gonna do like Facebook did with their customer. They will gonna do the job themselves. And we believe on that two aspects of the market for bank, but also for fintech like our company. Thanks.
I do believe in building upon what he just said, and I'm coming here from the perspective of, as the CEO of ICA Consulting, what we really do is to help leaders in banking and financial institutions to build more innovative, inclusive, and forward-thinking organization. And when it comes to transform the bank on the digital aspect, there are two aspects. You have the content and you have the context. In terms of content, there is a need for banks to really simply invest in technology, as simple as that, but also invest in upskilling their team, giving them the team to be able to move towards that direction. And on the other side, you have the context, which is where we work even more, is supporting leaders in banking and financial institutions to kind of give life to their commitment to digital transformation as leaders, but also to create an innovation culture within the organization, because you can invest in technology, you can train people. Even if you are committed as a leader, if you don't invest in getting help to build, establish, and develop an innovation culture within your organization, the digitalization, the digital transformation is not going to bear the fruits that you're hoping for. So that would be my advice. Thank you.
I have a question for the audience, actually. So a quick raise of hands. Does your organization work with or collaborate with startups, fintechs, or other innovators? Yes? Some of you, around half the room. So that's my takeaway, is collaborate. Collaborate with fintechs, partners, startups. I think this is a world that's evolving so quickly, so find ways to collaborate. Private and public partnerships are becoming more key. That's my key takeaway for today.
With companies like Integral, I assume.
Of course, and others on the stage.
I would ask one question. Where are you strongest today? Is it consumer lending? Is it FX? Is it corporate banking? Take your strength and focus on digitizing it and making it as accessible to as many people as possible.
Thank you. Concise.
Yes, maybe just one word. Humans are the end game. So even if you have technology, really make sure that this technology is for humans, because at the end of the day, humans are the ones who evaluate what is valuable. They are the people who set value, and they are the people who take action. So humans are the end game. Make sure that your organizations use technology to make data-driven decisions, but for the sake of humans, their employees, their customers, or more general, the communities where they act.
Thank you so much. And I think with that, we'll close up the panel. Thank you so much for all joining us. I really appreciate every piece of insight that we've got out of this. It's been very educational, I'm sure, for them, but definitely for me. So I thank you all for your time, and I'm sure the guys will be around, so feel free to ask more questions to anyone that you see having coffee. Thank you so much.
Thank you. Thank you very much. Ladies and gentlemen, please don't leave the room where the rule is still standing. We'll take a family photo with all of the speakers of this amazing panel who enlightened us on the issues of digital. Please rise up and you can take your picture. And then I will introduce the next keynote speech, which I'm sure you're all expecting because we have the face and the voice of foreign direct investment with one of the most seasoned professionals in the sector and a living legend when it comes to explaining how FDI works, how the landscape is changing, how the whole world is completely changed and the value chains are all changed. Thank you very much, ladies and gentlemen. You can give them a round of applause again for their participation and for everything we're doing. As you know, we're amazing in Morocco when it comes to logistics, so we have to remove these chairs and make sure. So a little bit of house management before I introduce Courtney Fingar, who's going to be our next keynote speaker. And I'm sure you're all eager to listen to her and to the insights she wants to share with you. In 30 minutes, all taxes included, we will go for a coffee break, and then we'll come back for the next panel at 11 sharp. So ladies and gentlemen, without further ado, let me introduce Courtney Fingar. She's the founder and CEO of Fingar Direct Investment. And in her 20 years career in business journalism, she worked for the FDI magazine, for the Financial Times, and she served as head of content for its associated data division, FDI Intelligence. And she covered business stories in more than 80 countries. If you want someone who's knowledgeable about FDIs in the whole world, this is her. Ladies and gentlemen, welcome Courtney Fingar. Courtney, the floor is yours. Thank you very much.
Thank you so much. I'm really delighted to be here. As mentioned, I'm Courtney Fingar. I was a journalist for many, many years, focused on foreign direct investment, and now I'm a consultant advising governments on how to attract FDI. A big focus of the talk, following nicely on from the previous panel, is on digital FDI. However, my clicker has gone missing, so you'll have to bear with me until someone brings it to me, and I'll have to prompt as the slides go on. I will start with the big picture, talk about the landscape, the environment around FDI that's actually creating the framework for FDI, talk about what the data shows us and the implications of that, and a bit of the way forward. One caveat, there will be quite a lot of charts and graphs, which is probably not what you want when you're antsy to go into a coffee break, but I promise those charts and graphs I will not delve too deeply into. They're really just to give you a snapshot of what's going on, and also we cannot talk about FDI without looking at what data shows us. So we'll start with the big picture. Macro trends that are impacting FDI flows. Now, there are a lot of them, and most of these are interrelated, but these are the ones that I feel are the most significant. Now, COVID, although the crisis itself has subsided, the implications ramble on, and some of the changes we simply won't go back from. And COVID has really had a part to play in many of these other chains, these other trends rather, namely supply chain disruptions. We're seeing wholesale changes in global value chains. I think of it like someone threw up a puzzle and all the pieces have landed scattered around on the ground, and we don't yet know where they're going to fit together. Countries are now trying to find their new place in the changing global value chains because the COVID crisis exposed the vulnerabilities of many companies' supply chains. Now, that was centered a lot of that around China, but there were other places where there were shutdowns and the trade and supply chains broke down. What that taught companies is to not be reliant on any one place and to rethink how they structure their operations, how they move their goods around the world. These changes are still taking place, and they're impacting trade and investment heavily. Automation and Industry 4.0, I'll talk a little bit more about Industry 4.0 as we go along, but COVID showed the importance of automation, but also tied to that, remote working, digitalization, all those things we just heard about in the previous panel were trends that were already in place, but they were rapidly accelerated by the COVID crisis. ESG looms very large now in company decisions. I'll get much more detail about this, but also companies are now thinking more about things like the Sustainable Development Goals and making investment decisions actually based on that. Closely tied to that is the race to net zero and sustainability. Again, I'll delve a little bit more into that. Protectionism, I'm going to talk/rant about a little bit later, so we'll leave that from now, but there is a very clear trend towards barriers coming up to trade and investment and increased protectionism. Regionalization is an offshoot of these changes in global supply chains as companies look to shorten those chains, but it's also related to geopolitical changes and tensions that we're seeing. Many places are kind of battening down the hatches. I'll get more into that. It has sparked fears of a de-globalization. Now, I'm not going to delve too far and get very much into the geopolitical tensions, except to say we know what they are, and they are impacting trade and investment. So, FDI, trade, and investment tend to follow geopolitics. So when there are major trends impacting geopolitics, that impacts trade and investment. Now, that's always been the case, but these days, it's much more significant of a trend, and the data really shows us this very clearly. We're talking now about geoeconomic fragmentation. What does that mean? It really just means a fragmented, splintered, divided, and sometimes divisive FDI world. We're seeing a lot of friendshoring. I'll talk a little bit more about it and show you some trends on that in a moment. But at heart of the geopolitical tensions, you're seeing the trade and investment flows following that. So countries trading with and investing in friend countries. And by friend, it means political friends. Now, this is most marked when you look at everything related to the US and Europe and China. So we're seeing the US FDI into China plummeting, and that's had major implications in China's FDI performance, because for all the talk of competition, the US was actually the biggest investor in China, has gone a bit cold. Meanwhile, US FDI to India, a friend-aligned country, has increased, and we're seeing a boost in India's FDI performance as a result. Meanwhile, the other direction, Chinese FDI into the US has not declined to the same degree, but it has declined. And also Chinese FDI to Europe has declined, while European FDI to China has declined. You see other interesting trends, if you're looking at US investment, and I'll show you in a minute why I'm focusing on US investment, not just because I'm American, but the US is still the largest outbound investment, or is source of investment. So when you have changes in where the US invests, you see major changes in FDI performances globally. And you'll see strange increases in countries like Colombia, Costa Rica. Now, they have their fundamentals that make them attractive for investment, but these are really benefiting from twin trends of friendshoring and nearshoring. These are countries close to the US that happen to be friendly with them. So now this has a major knock-on effect on FDI, and in particular, it's very risky for countries that are overly reliant on FDI, but in particular, smaller, vulnerable economies, developing countries that maybe need FDI from both US and China, for example, and feel a bit caught in between, and it's getting harder and harder to play both sides. Countries need to have a diverse pool of sources of investment, because any major problem in your major source of investment can cause you problems. But the trends now aren't moving that way, so it leaves a lot of countries really exposed. Again, maybe they align themselves overly with one source, but political relationship broke down, and now they're suffering for that. A good example of this would be, for example, Bangladesh. Now, this is a country that should be raking in tons of FDI in a fast-growing region of the world, huge consumer market, low cost, has a lot going for it, manufacturing capabilities. But the political environment there, where the US and Europe are now, let's say, opposed to the government there and putting in sanctions, is going to drastically harm that country's ability to bring in FDI. Can they compensate enough by getting FDI from China? Probably not, because Chinese outbound investment is declining. These are the dilemmas countries are facing. If we go to the next slide. Just to illustrate again this friendshoring trend, again, it's related to nearshoring, investing close to home, but investing in friendly places close to home is the name of the game. Again, just showing you this is trade between the US and China and how it's essentially fallen off a cliff. Hope you can see this well enough, and I did warn you there was going to be my charts. Here they come. This is just to show you that there have been global declines in FDI. Major source of data for FDI is UNCTAD, the UN's agency that's concerned with FDI. They put out a big report every June where they recap the trends of the previous year, so I thought I would show you what that found. 12% decline in FDI in 2022. Could have been worse, and in fact, UNCTAD admitted they thought it would be worse. But it's very uneven. Developed economies actually took the biggest hit with a 37% decrease in FDI last year. If we look at the different types of investment, so those are headlines. If you take all types of FDI and put them together, that's what you get. Greenfield FDI, which is what in the industry we call the real FDI. This is productive investment, physical facilities, adding new headcount. This is the type countries are often most concerned with, actually increased last year, so that's a bit of good news, whereas M&A declined, and it was M&A that actually helped drag down the value. Now, projects we talk about in numbers, not actual value, so what we saw is there were more projects last year, but of a smaller actual numerical value, which means companies are hedging, putting more projects in more places, but not going all in on one big facility. What's driving the project numbers? A lot of it in infrastructure, global value chain intensive industries. I spoke about that as we start to reallocate and look for new global value chains. You're seeing investments that come about. Semiconductors, super hot. That was an area that got really exposed by the supply chain problems. So companies are looking to solidify their sources of semiconductors. Many locations around the world are promoting their strengths and trying to develop their competencies and attract semiconductor manufacturing facilities with quite a lot of success. Interestingly, investment related to digital economy declined last year, but that's really because there was a huge increase because of COVID in 2021 and 22. So we're just seeing a little natural leveling off there. And where are the projects and investments going? US is still the biggest host economy for FDI, followed by China. It's a little deceptive though, because you'll notice you have China at number 2 and Hong Kong at number 4. A lot of investment in and out of China is actually routed through Hong Kong. So if you were to combine those two, you would have China much more neck and neck with the US there. I would like to highlight Poland here for special note because I think it's often really underappreciated. Poland is now quite a major economic and political force in Europe, and the perception hasn't really caught up with the reality and has been an FDI star for a number of years and is now cracked into the top 15 globally. Now again, if we look at type, that previous chart was all types of FDI. US out in front by a long shot in terms of tangible greenfield investment. Interesting, China is nowhere on that list, whereas India is number 3. So that was where the projects and the FDI is going to. Where is it coming from? As I mentioned, US still the largest source market for FDI, and again, that's why it matters a lot. How US companies are reacting to geopolitical trends and where they see advantages, and also what pressure is coming in terms of interventionalist policies. It's clear that the US government, like all others, incentivizes certain types of investment activity and investment destinations and decentivizes others. Repeat. So it's all a little bit gloomy in terms of FDI with these declines. UNCTAD says it's not actually going to get a lot better this year. In fact, a few weeks ago, UNCTAD had every 2 years they have a major FDI summit, and the head of FDI for UNCTAD said he was beginning to think it was going to get better and thinking that their forecasts were too gloomy. Recent geopolitical events have dampened all that in potential rebound, and it looks like we're going to have a continued rough ride for FDI. This places a really heavy burden on investment promoters, so those entities in each country charged with attracting FDI, because they're under a lot of pressure. They still have targets. They need to attract investment. They need to create jobs, but they're fighting for their piece of a slightly reduced pie. Now, despite all this gloom and doom, if you actually speak to executives, they will espouse a much more bullish view. So one of the major surveys that gives us an insight into corporate decision makers is A.T. Kearney's Confidence Index. So now they say 82% of them will increase their FDI in the next 3 years. They think, despite all this talk of deglobalization, 87% say FDI will be even more important going forward. 63% are more optimistic than pessimistic about the global economy, and 66% say there will actually be an increase. Now, there are a few ways to interpret this. One is that this is a longer horizon. They're not talking about this year or next year. They're talking about 3 years out, so they're hoping things will get better and taking a slightly rosy view. But if you look at the actual FDI numbers, it also suggests, despite the optimism and bullishness, they're not quite putting their money where their mouths are just yet. So if we look to the future and what will be driving FDI in the future and what the shape of future FDI will look like, there are a few industries that are really at the heart of this. SDGs, I mentioned, the Sustainable Development Goals, companies weren't paying a lot of attention to those up until a few years ago. Now, I'll show you some stats in a minute that show they're actually being talked about in company reports. It's a thing now, and companies are taking that into consideration when they decide where to invest. Tech, we heard a lot about this in the previous panel. I probably don't have to explain to you that technology-related industries are the industries of the future, and of course, FDI is impacted by that. One of them is data centers, which are necessary to support all this digitalization and data and digital activity, and we've seen huge increases in data center FDI projects globally. Renewables has been hot for a while, continues to be. It's been one of the few growth sectors throughout all the bumpy recent years in FDI data, a major industry for our host country here, Morocco. Gigafactories, I'll elaborate a little bit more on. They're probably the most sought after type of investment now, at risk of being overly trendy as an FDI project, but pretty much every investment promotion agency aspires to attract a gigafactory, and of course, Industry 4.0. So again, about SDGs, as I said, companies care more about it. So we've seen a trend since around 2016 that mentions of not just the SDGs in general, but individual goals get highlighted in corporate reports. And we've seen the actual increase in investment, so greenfield investment in sectors that could be tied to SDGs, increased by 39% in 2021, which is actually a pretty substantial increase. Renewable energy is one of these sectors that you could tag as an SDG sector, has seen steady increases in FDI. But it's a little uneven. So this comes again from UNCTAD's report and is showing the areas, SDG-friendly areas that are attracting investment. Infrastructure is a major one, and I guess it's a bit subjective as to how SDG-friendly you could consider any type of investment. Infrastructure, because it supports power generation and distribution and communication and all these activities, is considered an SDG sector. Renewable energy is probably a more clear-cut SDG sector, seeing increases, as I mentioned. Water, sanitation, also seeing increases. Now, where we get into a little bit more trouble is agri-food systems, which of course is tied to goals around hunger and health and education, which have very explicit SDG goals attached to them, have seen increases in between 2021 and 2022, but not enough to make up for the declines that they experienced before that, and more importantly, not enough to help meet the goals associated with these. And despite all the interest and the talk and the mentions in the company reports, there's some pretty alarming statistics, and most of the multilateral development organizations are kind of raising a fire alarm about the SDGs, saying we will not meet them by 2030, and a certain amount of investment is estimated to be needed in order to reach the goals, and we're falling short. And that UNCTAD estimates that gap to be as much as $4 trillion globally, including all sectors. And again, health and education are the two falling the furthest behind, and you could probably make an argument they're two of the most important. How can you reach any of the SDGs or even the spirit of the SDGs while falling behind in health and education? Renewables doing much better. You can see here, you don't need to get too bogged down into different shadings on this chart, but the overall trend is very clear upwards. This is international investment projects in renewables since 2011 to 2022, major increases, and a lot of this is driven by solar and wind. These are the two hot segments. And a kind of an interesting trend to note that ties that together is that renewable investment has surpassed in 2019 investment in fossil fuels. Now you can see the gap started to close just a slight bit more last year after fears of energy prices, but this is probably not a trend that's going to reverse. Despite this, a lot of developing countries are still struggling to attract FDI. And I have to apologize for my very bad typo here, which is that most of the money has actually gone to developed countries. And the real problematic bit is there are more than 30 developing countries that have not attracted a single significant renewable energy project. And this is a major problem. And of those, 11 are least developed countries. The biggest problem is in small island developing states, which are really struggling to win these projects. And this is something, again, that UNCTAD and other organizations are warning about and trying to come up with regimes to help drive some renewable investment into these countries that would need it, but also would like to have it. Where is renewables going amongst the developing economies that are attracting it? Brazil is the big winner, followed by Vietnam and Chile. Morocco here still doing very well in the top 15 here. A lot of that driven, as you'll know, by success in the solar industry. So, gigafactories, as I mentioned, they're highly coveted. Everyone wants them. The good news is there are more of them than ever before. In 2020, there were only 66 of these factories, and by 2030, there will be an estimated 155. Now, by gigafactories, I mean making electric vehicles. These are highly sought after because they're big dollar amount investments, so it's a good one that a government can sort of announce. They usually create a lot of high-value jobs, but also they help meet sustainability goals. I'm running out of time, so I'll zip through this, which is just reiterating that previous point. Artificial intelligence, another hot sector that we've seen massive increases in FDI, and who's leading the race to attract AI projects is India. The US is the largest source of AI FDI projects, India winning the biggest bulk of them. So what's impacting FDI apart from the general global landscape? Well, of course, countries have a lot to say and influence about FDI based on their policies. As I mentioned, we're seeing more and more protectionism, greater barriers to trade and investment. This is very contradictory because everyone's wanting to attract FDI and putting in some favorable policies like subsidies, enticements, green policies to attract renewables, while on the other hand throwing up barriers to trade and investment. Now, taxation's always important when we talk to FDI. I won't get too into it because you need someone with much greater expertise than me, and also because of time. But the major trend is that global corporate taxation has been plummeting in recent years, and an offshoot of that is incentives, fiscal incentives for FDI, and a proliferation of free zones around the world using these enticements and incentives to attract FDI. However, new OECD rules on corporate taxation and the base erosion profit sharing regulations are going to completely change this, trying to bring in basically a global minimum tax, and this will force countries everywhere to reassess how reliant they are on tax breaks to attract FDI. That whole landscape is changing, but probably could do an entire presentation just on that. Safe to say, those changes are coming, and they're going to have a fundamental impact on FDI. So reaction to the downturn and a kind of panic about lower FDI was that we saw a flurry of investment policy making. So these are government policies that impact FDI one way or another. And here comes again the contradiction. So we had many more investment policies come into place, and they were more favorable overall to FDI, usually incentivizing green FDI. At the same time, we see also more barriers to trade and investment than ever before. This is a clear trend towards protectionism. However, if you see, this is where the colors of the bar graph matter. The red are barriers to do with actual goods. So we're talking about hard trade barriers here. And investment part is just the blue part, which is still very small, but it's grown. If you see in the previous years, investment barriers weren't really very many. It was the trade barriers that were usually the cause of protectionism. But we're seeing protectionism and FDI creeping in. More and more, part of that is more investment screening. This is where governments get involved and have special councils and laws to decide whether they'll accept certain types of investment. A lot of this is targeted, as you'll probably know, towards Chinese investment in the US and Europe. We've also seen a decline in investment treaties. These are, of course, treaties between countries that protect investors on both sides. So again, I find this all a bit alarming and a little bit silly because on the one hand, most countries accept they need and want FDI to meet their development goals or to maintain their economic development and economic growth. They're putting in some policies to try to bring in FDI. At the same time, we're seeing barriers, fragmentation, and walls. And protectionism, when it comes to trade and investment, is ultimately going to create decreases in both. So we're having a lot of warning bells, again, going off. IMF put out a report that was all about this geoeconomic fragmentation and saying, what can we do about it? And the only solution are continued multilateral efforts to try to keep global integration, keep the walls open. And again, warns that the most vulnerable economies are those who will be the victims, as it were, of this geoeconomic fragmentation. So I guess the warning and the advice to policymakers is it's natural to try to protect your economy and your citizens in times of turmoil, but the long-term implications of that can occasionally do more harm than good. And it's really good, it's important to have a long-term view on these trade and investment trends, what impacts they have, what are the knock-on effects of throwing up these barriers, not just in that policymaker's own country, but in their economic partners, and most importantly, in the most vulnerable economies around the world. So that's my pitch to keep the doors open to FDI for those of you who have influence, and many of you do, in your national economies. And that's me, I think, almost exactly on time. There was a lot more I would have liked to share with you, but please feel free to reach out to me. I'll be happy to share this presentation with you or discuss any of these topics further if you wish. Thank you so much.
Thank you, Courtney. Thank you very much. It was an amazing presentation.
Thank you.
I feel much more intelligent about FDIs right now. I don't know about you, ladies and gentlemen. We have the much expected coffee break, and then I invite you in 30 minutes to come back for the impossible quest and research for ESGs. So all of you, make sure you're here at 11. We have an amazing lineup of people who are gonna give us key insights about ESGs, and see you in 30 minutes. Thank you, ladies and gentlemen. Welcome back again, ladies and gentlemen. Like in The Godfather, just when you thought you got rid of me, you got more of me again, and I'm even moderating the next panel. So I hope the return on investment for this next panel on ESGs will be better than the standard ESG returns that we can see. Could you please welcome on stage my four speakers, Fatem Zahra Khalifa, Alexander Kateb, Banti Bora, and Farid Masmoudi, and let's get this ball rolling. Welcome, ladies and gentlemen, to this session about financial markets and environmental, social, and governance issues, embracing sustainable investment and responsible practices. We will dive in today into the intersection of finance, sustainability, and explore how ESGs and ESG consideration are reshaping investment strategies and corporate practice. When I was preparing this panel, I realized something, that ESGs are like urban legends. Everybody heard about them. Some people claim that they have seen an ESG, but most people don't believe that they really exist. So basically what we're going to do today is steward this conversation with our four great and knowledgeable speakers and see how we can tell the real story of ESG, how it impacts your day-to-day business. And just take one thought. If 10 years ago we would have told you that a company based on a rumor and based on medias will have its stock depreciated by 25 or 30% because there is a rumor that they did not comply with ESGs, nobody would have believed it. But this is the world we live in right now. To guide us through these critical topics, I have with me four speakers. Fatem Zahra Khalifa, you're the General Manager of the Renewable Energies Cluster Climate Innovation Center, and you bring a wealth of knowledge in renewable energy and sustainable practices. Alexandre Kateb, you're an economist, a best-selling author, and you have the double expertise that we are all seeking because you're an expert on BRICS, and you wrote a bestseller book about it, but also about Arab economies. So you are at the core of the conversation we're having today. Banti Bora, you're the CEO of Biologic and Global Partner at Antler, a VC firm. And your expertise lies in fostering sustainable business practices in the biotech and investment sectors. And you've been the face of Goldman Sachs in India for several years. So you can bring us this view of the financial sector and the VC sector. And Farid Masmoudi, you're the Deputy Head of Investor Relations, MENA, and Head of Investor Relations, Central Asia, and BIM at Ardian, one of the largest private equity firm in the world. And you have deep insight into the world of investment and its intersection. Ladies and gentlemen, as we start this conversation, and before I kick in, let us all reflect on the words of Mark Carney. ESG is not about philanthropy. It's about risk management. So it encapsulates the idea that ESGs are vital in managing our investment risks and not just moral obligation. Fatem Zahra, let me start with you. You are in a way, and we are in Marrakech today. And by the way, ladies and gentlemen, this is Independence Day today in Morocco. So I'd like you all to acknowledge this and give a round of applause to our kingdom who's hosting us today. I think it is iconic that we're having the Interarab Cambist Association meeting here in Morocco the day we celebrate our independence, because Morocco is becoming multipolar and is paving its way. So we have the Moroccan way now. So Fatem Zahra, as I said, you're the voice in this panel of the Global South. So let us start by you. Could you do a scene setter for us about these ESG issues?
First of all, thank you for the invitation to speak in this prestigious panel. And thank you for such a huge responsibility to talk on behalf of 78 countries of the Global South. It's not going to be a piece of cake, but I'll do my best. So before setting up the scene, I would like first to introduce my institution. The renewable energy cluster that hosts the Moroccan Climate Innovation Center is a platform that gathers the key stakeholders within the green economy and the renewable energy transition. Our members represent the private sector, the governmental institutions, the financial players, and also the R&D and academic field and key operators. Our main goal is first to be able to create national green and competitive ecosystem, but also to promote green investments opportunities in the Moroccan market, and also to foster innovation and to deploy as much green solution and clean technology as possible for the Moroccan market, but also for the African one. Saying that, I want to give or to share with you some figures before talking about or setting up the scene, as you said. First of all, in terms of sustainable debt insurance in 2021 for emerging markets, it reached almost $200 billion. Also, in terms of specific bonds, so gender bonds, green bonds, social bonds, they have tripled in the emerging markets compared to the 2 last years. And I want as well to associate figures about the renewable energy capacity market. So I'll give you numbers, but then you will see the links between all these numbers. Irina just said and stated in its last reports that the African country has more than 300 gigawatt capacity of renewable energy by 2030. But at the same time, only 5% of global investments in the green and renewable energy in Africa, less than 5% of the global investments. So how we can have as much potential and having only 5% of green investment in Africa. This is really an important fact. Saying that, as you may know, that our economy has suffered from several crises this past years. Many of the South countries shown resilience, but the majority suffered from this impact, and mainly the impact of climate change, especially the African continent, which is the less emitter of green gas and carbon emissions, but is the one who suffers the most from the impact of climate change. So how is the financial market today in terms of setting the scene? How can the financial markets and investors help and face this situation, and especially regarding climate change? First of all, that could be interesting to make this integration or incorporation of the ESG criteria mandatory in all the investment making decision. That first would promote the green investment, but also create a real market and push investors toward all the opportunities that the South countries could offer, and particularly the African one. Second thought that I would share with you is the fact that today we need to have more innovative financial instruments and more thematic funds, funds that would be more segmented to target specific sectors with impact like education, food security, renewable energy, sustainable infrastructure, and as many specific bonds as possible, gender bonds, social bonds, green bonds, and other new type of financial tools that would be actually answering the needs of the country and being able to promote impact investments. As you may know, there is funds like the Green Climate Fund, which is totally dedicated to the green. But when we go to numbers, there is very few projects in Africa that has been financed by this fund. So maybe there is a gap. We need to fill that gap. The financial institutions have this role of building capacity, of assisting the African country in making their projects more bankable, in helping also investors to target the right projects and making them as bankable as possible and also scalable.
Okay, so Alexandre, let me turn to you. Fatem Zahra is talking about the much needed come together dynamic that we need. But as you know, and you're the specialist of emerging markets and Arab economies, we only come together when one of our countries reaches quarterfinal of the World Cup. So how can we really create this dynamic of having, are we market ready in our region, in our economies, to fully implement ESGs?
Thank you, Abdelmalek. I think you pointed to the right issue. Are we market ready? Because at the end of the day, I think ESG and the progress of ESG in our economies is clearly related to the progress of capital markets and integration of capital markets within the region. Because most companies, when they implement ESG guideline, voluntary guidelines, for example, they do that because they are listed on some market in the region and they want to attract investors that are ESG aware. So this is, I would say, a slow movement, but a movement that is gaining traction and that will gain traction in the future, depending on the appetite of investors, and especially of institutional investors for this type of asset. The problem that we have is that in the MENA region, actually, there is a scarcity of institutional investors. Most of them are located in the GCC, Saudi Arabia, in the UAE, and the other GCC countries. But when you leave the GCC region, then you really have a scarcity of those institutional investors, pension funds and the like, that could act as a force for pressing this and pressuring these ESG agendas on the listed companies and through a trickle-down effect on the other non-listed companies in the region. So I think this is clearly interrelated. The second driver and the second issue is the structure of the economies in the region, which are mostly dominated by small and medium companies. And for these small and medium companies, it is very difficult to implement these guidelines because it has a cost, obviously, and the cost of doing all this red tape, of filling these forms and complying with those regulations, including the voluntary or compulsory reporting guidelines that are being upgraded and ramped up across the region, starting from the GCC, Saudi Arabia, the UAE, and gradually to the other countries. Morocco also is a good example of such regulatory upgrading. But at the end of the day, you should balance the cost of these regulations with the benefits that you can get from them. And imagine ESG regulations that would be practical and that would be effective.
Okay, so Bunty, Alexander, coming from the continent of thinkers, was saying size matters. And there is a Pareto law in the GCC and Saudi Arabia and the EAU, and we have a predominant economy with SMCs and small companies and stuff. But you, Bunty, you bring us this unique perspective because you were, on one end, a banker. Now you're an investor. So you've seen both shores of this lake. Can you give us your perspective on ESGs now that you crossed the channel?
Yeah, okay. Well, first of all, thank you for everyone's attention this afternoon. Look, I think before I fully submit to the label of being a banker, I'll make the distinction between investors that have fiduciary responsibility and what I broadly describe as financial intermediaries. So people who are in the transition of capital or advice or movement of capital. Investors ultimately have somewhat of a herd mentality. There is an index seeking, almost like quality to behavior, because most of the incentives are aligned around not underperforming or meeting some parametric compliance or other criteria. Financial intermediaries have to respond to and react to like the movements and the cycles and the ebbs and flows of the market. And of course, markets, we all know, ebb and flow as they seek to find some stable equilibrium. So, you know, when I think about my own kind of intellectual journey through there, you know, I look at this and say, we've been through the lack of knowledge about ESG to a mania of ESG to a backlash against the mania of ESG. And I think we're entering the backlash to the backlash phase, which was written really coherently by Liz Hoffman at Semaphore recently, talking about some of the trials and tribulations of BlackRock around their attachment to this phase. So let's talk about what investors really ought to and really do care about fundamentally, which is returns. And so to me, that's not about the environment. That's not about social and governance as explicit outcomes. Those are factors, long-term factors, investment considerations that go into the seeking of returns and the seeking of risk management outcomes. There's a good article that was written, actually, I think like last month by a guy named Tom Gosling. He does some work at London Business School where he models out like long-term ESG sort of paths in terms of how much GDP impact, what kind of a, you know, is it a stagnation scenario, is it a meltdown scenario? And you see these massive, like divergences in terms of what look like economic outcomes. In 100 years, you know, the GDP of the world will be less than it is today in real terms. But then when you actually turn that into a simple dividend-based, you know, discounting model with real interest rates, which are not at zero anymore, and a cost of capital, you find out that if the world melts down, that probably means that compared to today's portfolio, a diversified portfolio is worth about 15 or 20% less. If the world doesn't melt down and everything is normal and nothing happens and this is all a hoax, then it's about 115 or 120% higher. So there are catastrophic economic scenarios that don't necessarily, in real returns, like instances, translate to actual investment outcomes. But that's not the way that ESG assets are gathered. And so I think that there was this sort of combination of investor preference, virtue signaling, in some ways like kind of performative theater about doing good for the world, and that created a surge of money into, in particular, I'd say in particular public markets. And so we had all these ESG funds proliferating, and you look under the hood and what do you find? You know, your old portfolio was predominantly Apple, if you're an equity investor, Apple, Microsoft, Amazon, JP Morgan, Alphabet, Pfizer, and you can think of the rest of the companies. And then you go to your ESG portfolio, and it's the exact same thing. It's Apple, it's Amazon, it's Meta, it's Alphabet, it's JP Morgan, it's Pfizer. Because the way that the idea of ESG was being captured had really nothing to do with their business models in the fundamental sense. So it wasn't necessarily driving outcomes in the sustainability space, it was meeting some criteria. So the last thing I'll just say on that is that these compliance-driven sort of ideologies, I don't think ultimately are the ones that are going to prevail for a whole host of reasons, which I won't detail now, but you know, probably the most insidious of which is that they promote greenwashing or other sort of like non-sincere behaviors. I think in the end, what you will find is that investors, and I believe will take a preference to transformative technologies or solutions-oriented, you know, sort of destinations for their capital, because that actually is a return profile. By the way, that also happens to have a sustainability outcome associated with it. And I think asset managers that try to continue to spin assets on the back of you know, narrative are actually going to find that life becomes a lot harder for them.
So what Bunty is saying, and I turn to you, Farid, is that the triple bottom line is not, as we thought, ESG, but it's from an investor point of view, it's more RRR, return, return, return. So basically what he's saying is that investors at the end of the day are rational economic agents. They wake up in the morning and they're in the Janet Jackson equation. What have you done for me lately when they ask the market? But if I turn to you and if we can have your view, because you work in one of the largest PE firms in the world, what are the main market challenges? And if you can even be a little bit more specific and take us through 2 or 3 sectors like food, mobility, and real estate, which are the real hot topics right now and are under duress.
Thank you very much, Abdelmalek. and I'm very happy to be back in this room with a lot of very familiar faces. I used to be in the capital market a couple of years ago, so I'm very happy to be part again of that audience. You're right. At Ardian, you know, we manage 160 billion. We do see, of course, ESG as a new engine of growth, or as a new opportunity to transform a lot of sectors. And I think you mentioned two sectors that are definitely an area of focus for us. I will start with the food. I think you mentioned the food, and actually when we went and we had some discussion internally, maybe we can summarize all the challenges in 5 key challenges. The first one is on farming practices, and I think in Morocco here, we know that. You guys just go outside, you will see that how farming practices are being transformed and will be transformed. Transformed by the use of more organic, I think reduce use of synthetic input, and make sure that, you know, we're gonna promote a better soil health. I think the use of water, efficiency, irrigation system, I think that's the kind of practice that definitely needs to be supported. The second one on the food is on the supply chain, and I think that's a key topic, because supply chains start with transportation, and whatever can reduce the carbon emission, I think that's definitely where we are going to investing. The second one is also to storage facilities. And I think in all the facilities that will use energy efficient storage facilities will be definitely key as a destination of investment. Because you have energy, but also the waste that is very important today on the spoilage of food and the waste of food. I think on the supply chain, the traceability is a key as well element that there's a lot of investment on that. And this is where actually we are spending a lot of time and capital. The third one is on the local sourcing. I think the world has changed. I think everybody said, now we need to eat every day some, you take like berries, mixed berries, but I think this time we're gonna end soon. Because I think, you know, even though you have a new way of doing farming, but the cost of importing your berry from Peru, I think is becoming very expensive, and I think can make the difference. So promote local and regional sources, that's one of the key challenges. The fourth one is on the packaging and the waste reduction. I think packaging means plastic. I think need to minimize the use of packaging and prioritize the bulk purchases. And the last one, I think on the food chain is, again, investment on R&D. I think we see a lot of sustainable agriculture technologies and the use of alternative foods. So that's means that I mentioned 5 key challenges that are a complex process that will require a lot of collaboration and improvement across all the value chain. But let me move to another one on the mobility. You know, at Ardian, we manage 23 billion in infrastructure, and mobility is one of them. And we just launched last year the first ever hydrogen dedicated fund. It was a 2.5 billion euro hydrogen dedicated fund that for the first time in the history is the first fund fully dedicated in hydrogen. And for us, it's a fund that we can deploy all over the world in all the value chain. So for us, that's key because hydrogen means, of course, a lot of cars that could be powered by hydrogen, but need also a lot of investment. And if I come back to the mobility, I have 3 key challenges that I would like to share with the audience. The first one is on electric vehicle. I think the manufacturing, and we see here in the country of Morocco, I think there is strong leadership that really wants to bring manufacturing and production facilities. But I think we need to do much more on batteries and on charging infrastructure. That's the next engine of growth. On the public transportation, that's another challenge. It requires more buses, more metro, more trams, all the system. But also it requires a smart transportation system because we need to use technology that will optimize the public transportation use and to make sure that we will have some more, let's say, friendly and passenger experience. It's not about putting everybody in the bus if people are struggling because the buses are overcrowded. That's a challenge that we face a lot in the West, but this is something that we can definitely improve by the use of technology. The third one, and we start to see it all over the world, you go to Dubai, you will find a lot of biking lane, a lot of cycling and walking infrastructure. That's things changing. I think we need to invest a lot to promote pedestrian-friendly environments. That's mean sidewalk, crosswalk, or any type of infrastructure that will prioritize pedestrian. The fourth one is the shared mobility services. How we can, for example, use micro-mobility solution in order to not use the car for short distance travel. Means e-scooter, means e-bike. This is something that makes the difference. We heard a lot about the autonomous vehicle. I think it's coming. It's coming, but it will definitely will be coming if it's improve the safety and have a big impact on environmental. The last one, and actually there's two other ones that I would like to share with you, is the alternative fuel. I think I mentioned earlier that we are working on a big hydrogen fund. And hydrogen, it's another way. We can use EV, but hydrogen infrastructure are a big as well, a factor for us. We're spending a lot of billion in order to support the development of hydrogen-powered vehicle, but also all the charging and all the production facility. And biofuel and synthetic fuel as well are key for the transportation, especially for the aviation. So in a nutshell, this is a type of challenges, but I mentioned earlier on the food value chain, it's a complex that will need involvement in the whole value chain, but on the mobility, I think we need public and private sector definitely to be involved on that one to transition.
Thank you very much,
Can I
Farid.
just add something on that?
I will get back to you. Monty, you want to say? I just have to confess that I got lost at a point. When you said 160 billion, that is a lot of money, but we can go. Monty, you want to comment? You want to comment on that? You have 60 seconds.
Yeah, one thing I would just add, though, is that the challenges, as well as the specific verticals that you're talking about, all are investable. Like, there are companies that will be created. There are subsidiaries of businesses that will be built. There are public-private partnership projects that will take place that all will address these challenges or tackle these verticals. That is a very, very different investment opportunity set that is much more, I think, return-focused as well as sustainability-focused than investing in a company based on their net zero claims or their non-credible sort of like assertion that they will be better to their stakeholder community over time. I think those empty promises that public companies have are the ones to avoid, and it's more like these opportunities.
I think we'll get back to this because it's a much debatable question. There are different point of views for this. The thing that is not debatable is that the Kingdom of Morocco is heading towards net zero. Fatim Zahra, let me get back to you and take this conversation closer to home. Under the leadership of His Majesty the King Mohammed VI, may God assist him, Morocco is very much committed into getting to this net zero economy. Morocco held COP22, which was the COP of action. There is a very broad and ambitious initiatives. Can you give us a global overview of the Moroccan way, the way Morocco ambitions to be this actor of net zero?
So the Moroccan way for me is not only about setting ambitions, but it's more about delivering fast, delivering right, and delivering with impact. This is for me the Moroccan way of doing things. As you said, under his leadership, the Majesty, the King Mohammed VI, may God assist him, we had a real ambition, an ambition that I will resume in 3 numbers. So please keep in mind these numbers: 52, 20, and 18. What is this number? 52% of our electrical mix from renewable energy, 20% of economy of energy, and 18% reduction of carbon emission by 2030. So saying these bold ambitions, we have concrete projects and initiatives regarding renewable energy and the development of large-scale infrastructure projects. Today, we achieved 38% of renewable energy installed in Morocco, which represent 4 gigawatts. So 800 solar, 1,400 for wind electricity, and 1,700 of hydroelectricity. This is one of the biggest African investment in the world. Second opportunities of investment is green hydrogen. Morocco has positioned itself as an African hub, an international hub for hydrogen with an objective of capturing more than 4% of the green molecule demand around the world. And we just launched a few months ago our Moroccan green hydrogen offer. Also, the other opportunities within the mobility with an objective of 100,000 electric vehicles by 2025, and water. Water is a key investment green opportunity for Morocco with all the desalination, solar desalination power plant, but also our water highway that's just been implemented lately. Besides this effective and implemented project as well, the export of energy to European Union. Morocco has signed the roadmap with the European Union countries, and today we are implementing or developing a project, I think that you heard about it, the X-Links project, where we're developing more than 10 gigawatts renewable capacity in the south of Morocco to be exported to the UK and support them within their net zero strategy. And finally, one of the greatest opportunities is creating a climate finance market and a carbon market for Morocco, but also with an important part of the South-South cooperation. So this is, for me, the main achievements that illustrated the way of doing things. But as you may see, this dynamic would be further accelerated with the implementation of the Mohammed VI Fund for Investment, and also the new chart of investment that has been launched lately with a high ambition of 500,000 jobs to be created and more than 500 billions of investments. There is also initiative that has been launched by the Ministry of Finance and also our Moroccan Authority of Capital Markets about issuing green and sustainable bonds. So far, just to give you an idea, we have issued about 7 specific bonds, which is a very good start. Also, in terms of South-South cooperation, we signed in the COP22 a very nice initiative with 23 African countries to create an African financial market and promote this cooperation, but also different law that's making the ECG criteria mandatory for all investments acts in Morocco. So as you may see, there is a real dynamic and concrete action that has been deployed these last years.
Thank you very much, Fatem Zahra. Alexandre, let me turn to you. You saw this mounting debate between Farid and Bunty about market perspective and market opportunity. And we are in this very weird, heterogeneous region where we have the old tech, reliable but non-ESG compatible, and this new tech, hydrogen, which are not yet mature, and we're going into some kinds of uncertainty. Can we have our cake and eat it? Can we be a symphonic orchestra and a jazz? Can we have this old, reliable businesses that are still making money coexist with the future and the new tech that is coming? How can we have a coordinated approach amongst the Arab world and the MENA region in order to reach this net zero and to be on par with ESGs?
Thank you, Abdelmalek.
I reserved the tough question for the economists. That was the idea, because you always come up with an answer anyways. So.
I was going to say that. Thank you. No, I think you mentioned the right point, which is obviously the cooperation at the regional scale. Because let's face it, for the moment, we have a lot of piecemeal initiatives from different areas, different countries, even companies or investment funds, sovereign investment fund. For example, the Saudi Public Investment Fund launched its own sustainability initiative. So there are many different efforts, but what lacks is a kind of coordination mechanism for these different efforts. And this is also related to the lack of institutionalization or institutional cooperation in our region. As you know, actually the most prominent organization, which is the Arab League, it's kind of an empty shell. And if you want really to have an efficient organization, you have to go at the infra-regional level. You have the GCC Cooperation Council, which is the best thing you can find in the region. And then you have some cross-regional initiatives like the Red Sea Economic Corridors.
There are competing
in this conversation. Interests, but there are also common challenges. As Farid mentioned, one key challenge is water scarcity. And this is obviously a common challenge across the region. Whether you are a commodity exporting country, a rich country, or a poor country, or a commodity importing country, whatever, you are facing the same water scarcity challenge. So you have to put in place this kind of regional guidelines and regional frameworks for investing more funds into this sector through capital markets, through private equity, through green bonds, and so on. And so the leaders in the region must take the responsibility. Actually, a few years ago, Qatar created an organization for arid lands, I think, and they invited me for a debate with the general manager of this organization, and I felt that there was a genuine concern to implement a vision for the whole region. And this is what we have to do, first starting sector by sector, issue by issue, and then coordinating all that in a kind of bottom-up approach if we fail to implement a top-down approach, as we can see, for example, in the EU, which is at the forefront, obviously, of these issues, or in China, which, given its political and institutional governance, naturally has this top-down approach to these issues.
Okay, so Bunty, Alexandre is talking about top-down and bottom-up approaches and try to vest this competing interest. In your position, maybe the audience doesn't know that, but both sons of Bunty are race pilots, so they're in Formula 3, I think. So,
perfect thing to say on an ESG panel.
Yeah.
The panelist has two very unsustainable.
Absolutely. So you have to compensate. And, as I said yesterday, I accept checks and major credit cards in case you want to pay me back for what your children are doing. But let's introduce the notion of speed, because Farid, Alexandre, and you mentioned, I think, that water is paramount. And if you want to run a race, you need water because you need your body to be able to have the vitamins to run. But are we in a speed race or in a marathon? Because if we listen to, if you take 10 experts on ESG and you put them in a room, you get 10 conflicting stories about the sense of urgency that we should have. What's the sense of urgency that we should have right now? Is it a speed race or a marathon?
Yeah, okay, so racing, motorsport in particular, I'd say is an interesting metaphor for life and for exactly what you're describing. So who wins a race, right? Is it the fastest? Is it the smartest? Is it the richest? No, it's the person who crosses the finish line first. Crossing the finish line first is not a function explicitly and exclusively of speed, because you actually have to finish the race, which means no accidents, which means not getting caught up in an incident, which means the management of your resources during the course of a race. Speed is an important component for sure, but what is speed? Speed in a car on a racetrack is your straight line speed, but it's also your cornering speed, which is a function of your mechanical grip and your aerodynamic grip. But then that has a consequence of tire wear or fuel consumption or the ability to attack when you want or defend when you want. You get the point. There's a lot of telemetry, there's a lot of data, there's a lot of judgment, there's a lot of experience, there's a lot of strategy that goes into winning a race, which is really finishing a race in front of everybody else. And then you throw into that the fact that conditions are never the same in markets, in economies, in the world, even societal and political changes, very much like challenges that need to be adapted to. So when I think of whether it's a sprint or an endurance or a marathon or a street race, that's not, like, to me, that relevant, because the factors that drive the winning a race or the not finishing and therefore losing a race are identical. You may manifest them differently. And so what would those sort of elements be in our current world? Well, first of all, I think...
So are we in a curve or in a straight line right now?
Well, this is the problem, is I don't think people know. I think there's a group of people who think we're in a straight line, and so they're on the gas as hard as they can. And then there are a lot of people who think they're in a curve, and so they're on the brake as hard as they can. And there's some people who are in the pits and haven't come out, and then there's some people who think they've already won the race because they sent a fast lap, but they have 200 more kilometers to go. So I think that diversity creates the race, that creates the excitement. And remember, it's not frivolously just running around a track, it's a test bed, for experiments and innovations that will actually drive solutions, in the automotive or in the fuel world or whatever, to use the metaphor. But I think that there's a place for everything here. Where there is probably some convergence opportunity, first is, the term ESG, I think it now carries a little bit too much baggage and probably doesn't fully explain the sort of intent, particularly if you take my point of view, which is that this is all about returns in the end. And so I think that, like, moving the world to a lexicon that talks about returns and talks about this space in the vocabulary of making investment decisions, returns, dispersion of outcome, risk, volatility, is super important, financeability. I think the second thing is that in the racing analogy, you need a lot of data, and you need a lot of telemetry information, you need a lot of sort of reconnaissance. Right now, there is no authoritative taxonomy really on much of the kind of investment overlay. And so these filters or these screens or these companies that are promoting these data services, they haven't gotten to this holy grail where they're able to take things that matter from a sustainability perspective and turn them into true investment criteria that can actually be acted upon. And then I think the last thing that is important is that we think about investor behaviors because that's the whole thing. But in a lot of these companies, and I'm talking about the private sector, the drivers of the interest aren't necessarily the drivers, no pun intended, aren't necessarily investors. They're actually the employees, because you have this whole group of people who are now part of, and employees as almost like to extend to the broader idea that they're stakeholders. And so that means that your race sometimes has to have different qualities to it to keep the crowd interested, to be able to sell the media rights. So my point in all that is that I don't think it can easily be reduced to fast or slow, straight cornering. I think it has to be taken in its full complexity, this whole space, which is you need to finish the race. You ideally finish it in the shortest amount of time. You'll need an army of people to make that happen, but you'll also need enough people who are participants of it, either by proxy as spectators or participants because it creates, because it's an economy, that that you have a real ecosystem and not just a bunch of ideas or a bunch of ivory towers.
Oh, so Farid, if I turn to you, Bunty was saying whoever crosses the line first wins the race, but in order to do so, he needs a team, he needs to go as fast as possible and hit the brakes at the same time. So this is like a classic example of economic trilemma. But Farid, you gave us a broad overview of the issues at stake. But let's talk about the elephant in the room. At the end of the day, how are financial markets hit and transformed by this sustainable investing trend?
Actually, I tend to concur to what you just said, and I will focus on private sector because...
So you guys you agree with each other now?
No, trying to concur means that we are in the same direction. Doesn't mean that we're going to the same finishing point, but we are running the same race. And we are on the private sector, maybe you can refer on the public sector. Because, we are big as well investors in a lot of private equity fund. We also have a strong platform of fund of fund. And maybe I can share with the audience the challenges that we face now whenever we actually need to invest in a fund, what we will have to require from the fund, and also what our investor needs to require from our side. Because you mentioned something, for example, about data, and yes, definitely, this is also a challenge, how to measure the impact of ESG. So earlier we mentioned there is a race, but it's happening, definitely. Now there is no single due diligence where there is no specific discussion on ESG. Take it or not, it's happening. It's key, and it's not only, and I can tell you because I do cover Middle East investor, but also a Southeast Asia investor. Usually, you know, with my colleagues that cover Europe, I said, I don't need to talk about that with the MENA investor, and they're not ready for that. It's changing. I can tell you from Saudi, I can tell you from UAE. UAE now is hosting COPs, and I can tell you there is a big change. And not mentioning about Malaysia investor as well. So everybody is becoming sophisticated on that. And now it's a key that there is integration of ESG factor in any single data room. Because there is two ways.
Everywhere, across the board.
Across, for all the private sector, it's mandatory. It's part of the due diligence item that you have, and you have to be ready. Because you mentioned ESG, but ESG actually, it's more than only ESG. It's SDG, it's employees, it's all the stakeholders. Because what we do apply, for example, in our direct investment, we're trying to monitor from the gender equality to the number of accidents during the at work, to the type of, let's say, diversity within the firm. So, and of course, looking at the sourcing, looking at sustainability, looking at recycling. So it's going across the cycle. Actually, for two main reasons. First, because this is a requirement from investor, and second, because also there is a lot of capital available for that. Today, it's also an opportunity to raise additional capital. I'll give you one simple example. We bought a district heating in Finland. We used to have as a fuel some fossil fuel for the heaters. The day we switched to biomass, the value of the asset increased significantly because the potential buyer of such assets has increased significantly. So this is just to give you an example of how you can create value just by changing, for example, the fuel that you will need for the heaters. So, and this could happen a lot. Not talking about the sustainable bonds, the green bonds that in some, I remember I spoke yesterday with one of the banker in Morocco and told me about a story, I think he's in the room, and sorry if I'm disclosing what you said yesterday, but I was saying that when Morocco was supposed to host the COP, all the big players, the multilaterals, said, we need to do something in Morocco. We need to have something like a green bond. I said, but I don't need money. I said, forget about this. We give you a fantastic pricing just because we want to do something. So that means that you can take such opportunities. So I think that's very important. I mentioned about the integration of ESG, but there is also a lot of products that are ESG products. We mentioned about the ESG focused fund. We just launched an impact fund on hydrogen. I think there's a lot of initiative on that. There's a lot of indexes. You take the MSCI, the Dow Jones indexes. That means that there is as well a lot of trackers on that one. But the third point I think that we don't mention yet is the strong activism from some shareholders. Now you have a lot of shareholders that wants to be very involved in the policy of ESG. Earlier in the process, say, guys, this is what you need to do. And if you don't do that, then we need to adopt a lot of stewardship codes to make sure that you will implement ESG. And that's key for them, because this activism matters now. The other point that we mentioned is the disclosure. You mentioned earlier that we don't collect data, but now there is a lot of requirement of disclosure. And to adopt a lot of principle. There is a PRI principle, there is a climate change principle. You need to do a lot of reporting on that. And you need as well to show how you measure this diversity and all this ESG. And then I would just comment on one point that you mentioned earlier about the financial income. People say that there's a lot of studies that show that the more likely you adopt ESG, maybe you're going to have a positive impact on your financial return. So if this actually is going to be proven in the long term, that means that there is a positive correlation between ESG and financial return. That means that it works, and a lot of people will continue to focus on that. But there is still some other challenge because climate is becoming a big issue. And now we also see a lot of investors that really needs that you do some disclosure about how your business will impact the climate. And for example, on real estate, now we also have the tenants that have to disclose about the impact on ESG. Just to show that it doesn't involve only the investor, but sometimes it's also involved, for example, on real estate, the tenants. So this is the type of discussion that we wanted to have with you and the audience.
Thank you very much, Farid. Let's, you know, we spoke about the world, we spoke about the region, we spoke about some countries, we spoke about sectors. Let's take this conversation up close and personal so that you guys can get to know better our amazing speakers. We'll do it in reverse order so we can be ESG compliant to have a lady finish the panel. Farid, let me turn to you. What small or big initiative in your personal or professional life, because we're imbalanced in the way we speak about ourselves or our organizations, have radically changed over the last 10 years and made you more ESG oriented and ESG, I would say, aware in the way you do things, whether it's in the way you travel or the way you manage employees or you change things?
I will take one simple example. I think for me is the electrical vehicle. And I think I mentioned earlier about all the challenge on the mobilities, but it comes with two things: incentives and subsidize, to make sure that people will adopt it as a widespread. And I can tell you, like the EV, I think it's changing a lot of things. Because for me, I can see it as a new engine of growth, a new source of investments, and also it has a direct impact on the carbon emission. And also it's changed as well a lot the urban planning, because I think it's something that's going to have a huge impact on the urban planning. And I think that's for me one of the key examples and on the mobility. EV and maybe hydrogen, but for me it's definitely EV.
Bunty, same question for you. What have you changed in your life to be ESG compatible?
Changed my life?
Yeah.
It's too late for me. No, I think, look, can I give you a perspective from my venture firms?
Yes, sure.
In a portfolio. So I'm a partner at a firm called Antler. We are one of the world's most active early stage investors. We operate in 27 different locations around the world. And all of our founders we're trying to write their first check. So we see something like 10, 20,000 founders a year, and all the VCs in these local or regional markets, as well as make about 500 or 600 investments per year across all of these jurisdictions. So there's two things that I would say that are coming together that's very obvious when you look at the grassroots sort of story from like a little bit of an elevated vantage point. One is that you have $70 trillion of wealth that in one form or another is going to generationally transfer from old people to their heirs, or from stewards that were from a previous generation to a different category of stewards. That new group, the receivers of that transfer are much more focused on impact than their predecessors. At the same time, you see a massive inflow of entrepreneurs, founders, people who want to build a business. Maybe because they're intoxicated by the idea of tech, or maybe it's because they've done the years working for a consulting or banking firm and they want to do something else. And a significant proportion, and I'll give you our portfolio statistics, impact is front of mind in terms of the businesses and the companies they want to create and build, and the solutions that they're targeting. So in our community, for example, basically half of our founders self-identify as more or less building impact-oriented companies. Now, 40% of the total is actually directly addressing some sort of a problem or a challenge that we would categorize in this space. But that understates it, because almost every single one of our companies, in some way, shape, or form, incorporates practices that have a sustainability element, even if their business or their targeted market isn't specifically about something in this space. Okay, 66, 70%, something like that, about a little more than 2/3 of our companies explicitly address or are aligned to one or more of the 19 SDGs, right? And this is not because we are an impact fund. It's not because we're searching this. We're a return fund. But this is what wants to be created, and this is also what wants to be funded because of those investor appetites. So, of course, and we have climate solutions and energy solutions and earth tech and, all kinds of the things that you associate with some of the topics we talk about here between, from water and mobility to biodiversity. But I think that the ones that are very, very interesting ultimately and the ones that end up getting our investment are the ones that are going to deliver solutions over time. So I'm actually quite sanguine about this. How am I going to change my life? I don't know, but I know that what we do is actually going to change the world.
Okay, thank you very much. Alexandre, let me turn to you and maybe take a small example for our French-speaking audience. Le monde est passé du présentiel au distanciel et on a le sentiment que tout le monde est maintenant en mode démerdentiel. How do you changed your behavior over the last years with this ESG pressure?
I'm really scared because I think you read in my mind, so I don't know how you managed to do that, but actually it's true that for me, the event that changed my life personally and professionally, apart from the birth of my daughter in 2020, it was the COVID pandemic. It coincided with the birth of my daughter, so I will remember it.
We have to disclose to the audience that this is live stream, so he's sending a message to his wife that he thinks about his daughter, but that's okay.
Right. But I was involved in policy advisory and different things before the pandemic, and as I got grounded during the pandemic, as many of you, I imagine, I started to do things differently, and I started to learn coding, which actually I never did over like 30 years. I learned some coding when I was 6 or 7 years old, but then I dropped that. And I started to learn coding, so I started to learn all the languages, Python, JavaScript, and so on. And it really changed my view of the world because I discovered what you can do with the software, what you can do with data, and with all the data that you actually have at your disposal and that you can translate into meaningful insight and actionable insight. So this is where I created the Multipolarity Report as a platform for promoting these data-driven and algorithmic approaches to economic and geopolitical issues. And I think in the sustainability area, this is something that remains unexplored. And I agree with Bounty that the current focus on compliance is not the right one. I think we have to focus on action, not on compliance with some criteria that could be seen as greenwashing. And data, especially machine learning, artificial intelligence, can help us move in this direction because it can help us uncover even the hidden intentions and the actions of corporate leaders or public leaders.
Thank you very much, Alexandre. Fatem, let me turn to you for the final thought. Alexandre was saying basically that his life changed and became more ESG compatible because he transformed himself into being a consultant, which is a useless person, to becoming a knowledge worker and learning. What have changed in your everyday business and everyday life that made you more ESG compatible now?
I did the opposite of what he did.
Okay.
Completely, I changed from being a consultant, so from earning a lot of money, to my actual job where I am.
So you chose to become poor?
Yes.
Right? That's a good choice for ESG, okay?
But within my actual job, I'm making real impact. And this is a real satisfaction. And I think that today we are all looking to give senses to our lives with all what's happening. Yeah, meaning to our lives. It's really important for us, for the new generation, with all the turbulences that are happening around the world. So I made that choice. I'm happy about it. But also, I discovered when I joined the cluster, we are working on the promotion of green investment, on entrepreneurship, on many social and green impactful projects, that green doesn't mean just philanthropy or doing nice things, but it's also bankable, profitable, and there is return on investment. These projects are becoming more and more profitable because of also the international context. Just one example, for example, the new Green Deal, the tax carbon that is today installed in the European Union border is making green projects more competitive than any non-clean project. So this trend is growing fast, and all this ECG practices and initiative is not for feeling better, but it's also for making your businesses and your investments more profitable with a high return of investment.
Thank you very much, Fatem Zahra. Let me concur to what you said and maybe mention the relief program of the United States, because we were all worried that the only plan that America had for years to reduce climate change was to switch from Fahrenheit to Celsius. But let's finish with your quest for meaning, which is more meaningful for all of us. I see a lot of people gathering in the room. Please close the doors in a few seconds for our finale. Ladies and gentlemen, could you please give a great round of applause to our 4 amazing speakers before we take it to the Super Bowl. Thank you, ladies. And you can take the family photo as well. Thank you. I'm invited, so. Thank you. Thank you, ladies and gentlemen. You are all expecting the moment, the big finale, the last keynote speech of our 2 days journey. I hope you enjoyed the conversations, the speakers, the people who helped us think and reflect on our journey and get us out of the trading rooms, out of our businesses. And now, ladies and gentlemen, I have a tremendous privilege and honor to introduce someone to give you the final lecture and the keynote speech for the closing of this Interarab Cambist Association conference held in Marrakech in 2023. You know you made it as a global brand when you are immediately recognizable by your initials. So Mr. Dominique Strauss-Kahn, you only say DSK, everybody knows him. So welcome, Dominique. We're so happy and so honored to have you with us today.
Thank you.
I think you need no introduction, but let us reflect on something that Mr. Strauss-Kahn once said on a television debate with someone who was president of France, Nicolas Sarkozy. And Nicolas Sarkozy was talking about economy, and he told Mr. Strauss-Kahn, "You are not the professor." And Mr. Strauss-Kahn, rightlessly so, said, "Yes, if you were my student, you wouldn't have made this stupid economic mistake." So let us all be his students today and listen to his out-of-the-box reflections on the global economy and pave the way for the future. Thank you very much,
Thank
Mr.
you.
Strauss-Kahn. We're very much honored to have you with us today.
Well, ladies and gentlemen, good morning. I would like first to thank the organizer of this conference and especially Abdelmalek Alawi for inviting me to say a few words in front of you at the end of these 2 days. This happened in a very difficult economic period, and difficult economic periods are very bad for economists because their work becomes uneasy and their contribution very uncertain. The reason for that is that economists learn to deal with economic cycle. They began to understand what's going on and propose some kind of instrument to try to master them. And before the pandemic, the main debate was about the so-called secular stagnation put back on the table by Larry Summers, which was, again, the problem is that the debate has shifted, totally. Shifted to something different because the cycle has been destroyed by something stronger than the cycle. And we used to call it a super cycle. Disrupted from external, unpredictable events, immediately comes to our mind the pandemic, wars, or thing of the kind. Typically, when you have this kind of super cycle, you have a disruption in the evolution of the economy, and the last disruption is the fact that after the 2008 subprime crisis, and with the immense quantity of liquidity which has been poured out, and then the raise in rates to try to mop up all this liquidity, we knew more or less where we were going. Then came the pandemic, came the war in Ukraine, and a few days ago, the war in the Middle East. We have experienced this before. Super cycle is something we know. We don't know exactly how to deal with, but we know how it works. And after a while, with more or less damage, we come back to the normal cycle. So typically, the end of the super cycle is to go back to the normal cycle without any kind of change or profound change in the way the production works, in the mode of production. Today, that's not the situation we're in. We are facing something much larger. I would call it a hypercycle, where the change in the production system is really what is at stake. It already happened in the history of humanity, but not that often. It's probably the case of the invention of printing, internal combustion engine, the industrial use of electricity, maybe the internet, I'm not quite sure about that, but it doesn't happen so often. So let me first question myself in front of you about this hypercycle. As everybody knows, it comes from the necessity of changing our production system imposed by the climate change. Some may add other changes like AI. I'm not quite sure it is of the same nature, so I will limit myself to climate change. We are facing, everybody knows this, an impossible equation, which is having growth, at the same time respect of the environment, and at the same time the refusal of the huge amount of investment which would be needed in research and also in changing the production methods. In the past, the choice has been easy. The choice was growth, respect of environment was not a concern, and sometimes some disruptive technology came which increased the productivity, but with no effect on the question of environment. And then, facing the disastrous and more visible consequences of this unsustainable mode of production, we had questions, and one of the answer was the one of the environmentalists. Basically, they say, okay, if growth is not compatible anymore with the respect of environment, just get rid of growth. It will take me more than a few minutes to say how simplistic this seems to me, but still I would like to put on the table a few ideas. The main one is that it's very difficult to know what growth is and to define growth, and even more to measure it. And if it's difficult to define and measure growth, it's even more difficult to define the decrease in growth or degrowth. Why? Many reasons. The most obvious are that growth encapsulates only a part of the economic activity. Let me give you some example. When, mainly in developing countries, a part of the informal economy goes to the formal economy, it increases growth. Do we really want to limit this? Of course not. When some part of the idle population goes to the labor market, women, for example, it increases growth. Do we want to limit this? Or when personal services develop, where the input is mostly labor with no influence on the environment, it increases growth again. And we don't want to limit this. So the question is not to limit growth. The question is to try to limit excessive consumption of resources and excessively carbon-intensive production. This has little to do with economic decline. It has to do with the change in the production system, and that is really what is at stake for us today. That's why we are facing what I called before this hypercycle. On top of that, most of the population on the globe will not accept this idea of a decrease in the economic activity. The poorest, because they don't want to abandon the promise of growth, which is a way out of poverty. The richest, because for most of them, they expect very good things from growth, let's say increase in life expectancy, progress in medicine, and so on. And for all, because growth is the condition of strength, and strength is the condition of freedom. So abandon this line will be something totally unacceptable for most of the population. So if degrowth is not a solution, what can we do? And that's my second remark. Many are talking about the change in the production system. When we look at energy, for instance, very little has been done so far. In 2019, only 2.5% of the energy was renewable, solar and wind. And this figures grows only to 12.5% if you add nuclear power. So we're very far from what we should do. And of course, energy is only one of the many areas where things has to be done, ranging from production of low-carbon cement and steel to capture and storage of carbon in the atmosphere to try to diminish the concentration. So we have to go in this direction. Of course, it will take time. As Mark Twain said, the secret of getting ahead is getting started, so we need to do something. I think it's obvious for everybody. But this means that we are facing an upheaval that requires massive financing for mitigation and for adaptation of the system. And this brings me to what has been discussed a lot during these 2 days, which is green finance. You're all experts, I'm not, so I will just ask questions as a layman. The needs are worth trillions: mitigation, adaptation, loss and damage. And frankly, it seems to me that we are light years away. The initiative in 2015 called Billion to Trillion wanted to use public money to mobilize the private sector. The idea was to bridge the gap by using the public money as kind of a leverage to de-risking the private investment and have a leverage effect. As you know, the term has been abandoned, but still the idea is there. And during the annual meeting of the World Bank and the IMF a few weeks ago here in Marrakech, it was omnipresent, in particular with people talking about PPPs. In reality, we are very far from the mark. The 2009 commitment of 100 billion a year given to developing countries to do so has only been reached this year, with what they say, and when you look at some report about that, namely the CGD, the Center for Global Development, led by Masoud Ahmed, the figures are even more worrying. They say 100 billion, okay, but half of it are not new or or additional. They say in this 100 billion, only 14% are private, coming from private sector. They say it's mostly tilted to mitigation with very little done to adaptation to the future situation. They say it's mostly international debt as opposed to equity or grants. So more generally, we have to think about and to ask ourselves what we can do about the limitation of green finance. I have heard a lot of things said during these 2 days, but I must say I'm still puzzled at least by 2 things. The one is the contradiction among the ESG rating providers. They are competing against one another, and so I wonder if any kind of harmonization in the standard is possible. Without this kind of harmonization, we often have some very bizarre outcome, depending on which kind of ESG rating you refer. Another question is that those ESG ratings do not really correlate with the financial risk. And it's understandable that they don't. But in this case, as a result, they're not very often used for trading strategy. So what is the way to incorporate this concern in the investment strategy? What is the way to really have a green finance which will not appear as something which looks more than as a greenwashing than something different? Look about carbon market. I'm a great fan of carbon market. As an economist, to put a price on something is always good for me. But the question is, there is not unicity of the market. There are several prices, of course, but more than that, there are many fraud which are reported. Maybe you heard about the one presented a few weeks ago by the New Yorker, where a major company, Volkswagen, Nestle, Delta Airlines, spent hundreds of millions on the so-called Cariba project, which appeared afterwards to be fraudulent. Of course, there are other fields of the economy where you have fraud. The question is that most people, I won't say most people, many people in the public look at this carbon market as something which is not really clear. They look at some rent-seeking problem with a lot of intermediaries trying to have their part of the pie. And frankly, it's little to say that the debt for nature market is very opaque. So this idea of greenwashing is very dangerous, because we need to have the development of green finance, but the perception that it doesn't work very well is something which destroys confidence. So many consider that we cannot tolerate anymore this situation, because the transformation of the production mode, the production system, is becoming a public good. It's something where everybody has its own stake, and it cannot be laid aside without some public authority intervention. This can be done through regulation, and I'm not going to come back to carbon market, but there are a lot of fields in which public regulation is needed just to have a market working correctly and avoiding negative externalities that we obviously find in this situation today. But there's another way for public authority to intervene, which is to provide resources commensurate with the challenge. And I'm going to say a few words about this topic. In 2010, I pushed forward an IMF staff paper entitled Financing the Response to Climate Change. That was 2010. And in 2015, I wrote an op-ed just in the context of the COP21 on the same topic. What was the topic? The topic is to say, in the situation we are facing, the IMF should be asked by the international community to issue a recurrent allocation of SDRs to finance the needs arising from climate change. SDRs are just money, creating money at international level. It's not very different. It is different, but not that different from what a central bank could do nationally. But we don't have an international central bank. We have the IMF and the SDRs. So, of course, everybody is against this idea. The IMF is very reluctant because the SDR have not been created for that. I'm not convinced. I did use the SDR in 2009 for something different from what they have been created for, and it was very helpful to get out of the crisis. The finance ministers are very reluctant because they say it will fuel moral hazard, it will lead to weak investment. But again, I'm not convinced because those arguments are right. But the argument holds also for any kind of public aid or development aid. You always have this moral hazard problem. Central bankers will be reluctant because of fear of inflation. Creating money in one way or another always results in some inflation. But frankly, that's a red herring. If you create $100 billion a year in SDRs, it is 0.1% of global GDP, which means the inflation you may expect from that at the maximum is 0.1%. 0.1% is not nothing for central bankers, but the question is irrelevant if really we believe that the future of humanity is at stake. And at the end, the MDBs, World Bank and other MDBs, will also be reluctant because they think they will question the inability of the IMF to manage such a fund, and they are right, because the IMF has not to manage, MDBs could do it. So everybody is reluctant, and that's probably the reason why it doesn't take place. Still, I believe that it is a very heterodox way to finance the transformation, but it may be the only one, because owing to the amount of money which is needed, we can do what we want to mobilize the private sector. We can do what we want to regulate the thing. We won't find trillions of dollars to do what has to be done in the coming decades, maybe decade. I have another very heterodox idea. For the first one, I'm not totally alone, because a high-level group from the UN has said something which looks like 10 years ago. For the second idea, I share it with George Soros, but not many others, which is the idea of issuing perpetual bonds. Perpetual bonds, again, is kind of a nightmare for the finance world. It has been used in the past sometime when really the situation was a dramatic one. Example, the Dutch did it in the 16th century to build polder, because it was a question of death or life. The sea was coming, they had to do it, they had not enough financing, the only way to do it was perpetual bonds. Still, some of these bonds are in the Dutch budget today. Of course, thanks to inflation, it's a very small amount of money, but they're still paying the interest on this perpetual debt. So, in normal times, there were would be no need for such kind of a heterodox solution. But we are not in normal times, and we need to do something. This will change radically SDRs or perpetual bonds will change radically the nature of the problem. Because if we again are in this historical situation where the future of humanity is in question, we cannot hesitate just for traditional and orthodox reason. It needs political courage and long-term vision. And of course, long-term concerns often fight away facing the urgency of other problems. And in any time, this kind of decision will be very hard to make, especially when the short-term situation, the super cycle, which I was talking about at the beginning, is not very encouraging. So let me come back for a few words at the end of this to this super cycle and the situation in the short and medium term. The outlook is very uncertain, to say the least. Growth seems to maintain in the US. In the Eurozone, it's not the case. Third quarter of 2023 will be around minus 0.1%, with some country, Germany, for instance, of around minus 0.5%, and the forecast is a probable recession in 2024. So obviously, the environment is not good to push government to make a bold decision. How did we get there? It's very well known. I just want to remind you something. Faced with excessive demand, mostly coming from the savings accumulated during the pandemic, the Fed raised rates in March 2022. And faced with excessive demand, the rate weapon was appropriate. In the EU, the resumption of inflation was not the same. It came mostly from price of commodity and especially from energy prices. And it hurts Europe much more than others because gas prices are regional prices as opposed to oil prices, which are global. So in summer 2022, when Russia cut off the supplies of gas, the prices in Europe increased 15-fold. Then central bankers and the ECB say we have to do something. And they use the standard tool they have, which is rate. And they raise rates to contain inflation. But faced with a cost-driven inflation, the copy-paste of the American policy was probably not the best thing to do. And the result is that, okay, inflation has fallen, but at the cost of stifling the economy. So we have now a very difficult situation in Europe because, in my view, the monetary policy was not really what should have been done. Now, having said that, is inflation really behind us? In a recent column, 12th October, Paul Krugman had this sentence. He said, "The war of inflation is over. We won at very little cost." And a few days after, Niall Ferguson wrote a piece with several arguments that I agree with, which make me doubt of this assertion, especially because of the uncertainty concerning the Middle East. We have to remind what the World Bank say. The World Bank say a reduction in Gulf export of oil of 2 million barrels, which is more or less 2% of global supply, will lead to an increase in price over $100. A war that would reduce export from the Gulf between 6 and 8 million barrels a day will lead to a price around 150, 145, 150. We have to keep in mind the Yom Kippur War in 1973, where the prices has been multiplied by 4. Of course, 2023 is not 1973, and prices are not going to quadruple. Still, I will not be surprised if inflation starts again. On the contrary, I will be surprised if inflation doesn't start again. So the war on inflation is not won. I don't agree with what Corinne say, and we will see in the coming months what is the reality. And for this reason, like Ferguson, I'm very doubtful about the pause, the so-called pause, decided by the Fed for the interest rate. They decided to maintain the level, but we are in a context of very strong budgetary expansion on one hand, in the context of uncertainty in the Middle East, and I'm not quite sure that this pause was, again, the right thing to do. So my position from this point of view is against everybody. I think the Fed should be more hawkish. I think the ECB in Europe should be more dovish, and they're doing both exactly the contrary. The reason for that is that I believe the post-pandemic inflation is not over. The first round is behind us, but now we're facing the second round. And maintaining the rates is probably for the Fed a mistake. This was March, last March, before the question in the war in the Middle East. Of course, nobody knows how it's going to evolve. Basically, everybody has in mind two possibilities. On one hand, the conflict is limited to Gaza. There's no blockage on the Gulf exports, and then there will be light economic consequences. On some European economies, which are on the verge of a recession, but still will be light consequences. On the other hand, of course, if regional conflicts breaks out, then a shock equal to one of the 70s is likely, with, as a consequence, global stagflation and, of course, a big risk of stock market collapse. For the moment, the market seems to favor the first solution, but we all know that on a geopolitical question, they are often being wrong. So let me just summarize this in a few remarks. I think it's not an overstatement to say that humanity has rarely encountered so many economic difficulties at once. It happened at a time where multilateralism has declined. Or maybe it's the other way around. Maybe multilateralism has declined because we have a lot of economic difficulties and everybody wants to solve it domestically. However, I'm absolutely convinced that there is no solution which is not a cooperative solution. And with a weak multilateralism, we won't have regulation of the green finance, emission of SDRs, whatever, or any, the solution I was proposing, but there are many other solutions, none of them will take place without a strong multilateralist attitude. It's not the case, it's not going to be the case anytime soon, and so from this point of view, I'm rather pessimistic. But again, if the future of humanity is at stake, then we must go beyond all our quarrels. And that's the message for me in all the political area today. We cannot at the same time say that we are facing huge challenges and decide that we're going to find a domestic solution in Europe, in the United States, in China, in India, and somewhere else. The need for multilateralism is bigger than it has ever been, I won't say that the mood is very encouraging, but what I see, IMF annual meeting, G20 conferences, things like that, is that step by step, people are understanding that they may not like each other, but they have to work together. The recent meeting between Biden and Xi Jinping didn't produce a lot of results, but it's showing the right direction. And I hope that if we meet again at the next conference in 1 year, the answer to this question and the news on multilateralism will be much better than the one we have today. Thank you.
Thank you very much, Professor Strauss-Kahn. You'll stay with us maybe for 1 minute on stage just so we can wrap up. And if I can just take two key takeaways from Professor Strauss-Kahn's communication. First, 1% of global GDP can change 100% of the current situation. And the second one, as we are surrounded by bankers, let's switch from perpetual movement that we like so much in our Swiss watches to perpetual bond, which will be much better. Ladies and gentlemen, a round of applause for Professor Strauss-Kahn. I would like for the final family photo to call on stage Mr. Tamer Khalifa, Reda Mkibrada, who are the leaders of this conference, but also the executive team who worked relentlessly those months. Rita, if you want to come as well for the photo. Malika, if you want to come as well on the photo. Si Mohamed Filali. So you can have also the people who worked relentlessly those months to deliver you this event. And so you can have the board of ICA, of course, of IMSM. You can come from the family photo. And as you know, it's the moment in a concert where you recognize the team of the concert. So I'd like to thank our partner company, Capital Events, Mera Malawi, Hisham Tayek, the people that you guys don't see but that are instrumental for this, Salma, Marcel, Fathi. I'd like as well to thank my team. So Salma, Sophie, Abla, and Victor. Thank you so much, guys, for making this happen. And thank you, the audience. You can applaud yourself for those amazing 2 days. Thank you so much for hosting us. Thank you, everyone. Thank you very much. And you can officially go to lunch, and the General Assembly is at 3 o'clock. Let me remind you, if you are not going tomorrow to the excursion, please remove your name from the list. Thank you very much, ladies and gentlemen, and that's a wrap.